Monetary tightening is not taking a bite out of the economy. This is bad news for inflation and bad news for the markets.
At some point in the future, we will see inflation coming back down to target.
We think that headline inflation is going to fall back to around possibly just under 3.5% by mid-year.
There's no sector of the economy that really is hurting.
This is an environment with very heightened macro and market volatility. We have to change our views very quickly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Where did February go? Hello, March. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Let's get straight to this market, up by about 1/3 on the S&P 500 as we get this morning started. TK, I think we have to begin in China. Upside surprise after upside surprise in Chinese data. Our latest reporting this morning suggesting that Chinese leaders are surprised by how well things are going as they reopen this economy.
I read the notes. John, this has happened 14 times before. I'm going to say back to 1968, but let's go back to 1978. It's all about property. They can't let property collapse. And what I saw within the reporting of Bloomberg today is it's not that there's going to be a property bailout, but they're going to move forward. And that's where you come to the 6% GDP estimates we keep hearing on Bloomberg Surveillance.
Were they reopening the economy after a pandemic in the 70s? Is that what happened?
I think that their solution is the only investment they have is property. And the bottom line is, everything said and done, property can't fail.
You saw Wei Li at the opening of this hour of BlackRock. Wei Li's looking for 6% GDP growth this year, and then Lisa ultimately looking for that to slide towards the 3s in the following years. And that's going to be the story. That's the tug of war.
And that's really what I wanted to highlight, that perhaps the authorities in China are celebrating this incredible data. Look at the reopening, but how much is this a messaging exercise at the same time that you have companies moving out of China if they can? And really, you're hearing about that more and more, especially with what we saw in Washington, D.C. yesterday.
So data good in China, under the radar, hardly being discussed today in China with Xi, Lukashenko of Belarus, Tom.
It's
Russian
there,
ally.
But you're right. It's an afterthought.
So if you're in this market, you've got a decision to make. Data's great. Do I want to be invested in China directly? Or do I want to go through China proxies and trying to avoid, basically, this tension between the United States and China at the moment because of what's happening with Russia and this war in Ukraine?
Yeah, I'll go with that. But I'd also say the traditional way to invest in China is through multinationals. And the optimists out there looking at the glass half full are saying we're going to get through this. We're going to get new data. We're going to get disinflation, and we're going to get, some form of life goes on, and that will be multinationals like Apple doing business with China.
That's the China data. We get some US data a little bit later on this morning. Lisa's going to go through the day ahead in just a moment. Your market looks like this. Up 1/3 on the S&P 500. A lift after the losses of last month in February on both the NASDAQ and on the S&P 500. Outside of the equity market, yields are a little bit higher. 393 on a 10-year. Tom, we've just been sitting here in and around 390, staring down the barrel of 4% over the last couple of weeks.
George Saravelis at Deutsche Bank, yes, on foreign exchange, but writing a more elegiac note this morning and just saying the next 2 weeks are absolutely critical. And you see that in the spread market, what the pros watch, John, 2 yields and the difference between them. I walk in this morning. I mean, I know you get in later. You get in at 5:52 or whatever it is. But the bottom line is I come in today and we got essentially a record vanilla 2-10 spread.
So we share the true story. I'm approaching the entrance of Bloomberg this morning and Tom shouts out, Tom shouts out, don't do it. Don't go in. Don't do it. Don't do it. And I think I badged in before you by about 10 seconds. But anyway, whatever. Futures are positive. Bramo up 1/3. Ton of data coming up a little bit later.
So that's basically the goal, to get in just before the other person, but not early enough that you can get there when I get there. Just saying, retail earnings do continue today. We get Kohl's, Lowe's, and Dollar Tree before the bell, American Eagle after the bell. Of course, Macy's and Costco all on deck later in the week. How much do we start to see a resurrection of some of the names that have done really badly this month? Year to date, there's been a lot of positive gains. Kohl's up 11%. But last month, in the past 30 days, you've seen it down about 15%. The volatility has been incredible. At 8 a.m., this to me might be the most important data point of the day. German CPI for the month of February coming out at a time when you have the Bundesbank saying they expect inflation to average 6 to 7% over the entirety of this year and possibly not get back down to 2% next year or even the year after that, at a time when they want to accelerate how much the balance sheet gets wound down. These are some of the debates that could be potentially potentially turbocharged by the data that we get out today, with the two-year yield over in Germany at the highest levels going back to 2008. And at 10 a.m., we get the other most important data point of the day, which is the U.S. ISM manufacturing data for the month of February, as well as prices paid for these manufacturers. Do we see any increase in some of the momentum in the manufacturing sector after what a lot of people thought was a manufacturing recession, John? This is the conundrum for the market. What if you get some sort of recovery in manufacturing just as you start to make progress in diminishing some of the inflation stemming from the services side of the economy? This is the push-pull of an asynchronous recovery.
Lisa, well said. As always, Lisa, thank you. The day ahead with Bramo there. Let's get straight to it with Jeremy Stretch, the head of G10 FX strategy at CIBC. Jeremy, Lisa was just going through the data that comes out a little bit later. I think I want to start with the ISM manufacturing in the United States. We had this robust read on the US economy in January. Big question we've all got is whether February confirms just some of that. Do you expect it will?
Well, I think we are going to see a modest improvement in terms of that manufacturing ISM print, but I'm not sure necessarily we're going to be getting back to an expansionary environment just yet. So I think we still have some headwinds, and I think we will be not only watching that headline number, but also looking at those particular components in terms of prices paid as underlined, and also the employment backdrop, because, of course, employment isn't coming out this week. So we have to wait for another week or slightly more than another week until we get the non-farms report. So I think we can and should see some sort of stabilization in terms of the manufacturing backdrop, but I'm not sure necessarily we're going to see enough momentum despite that payrolls blowout from January to point towards an uptick in terms of manufacturing sentiment just yet.
Jeremy, I am very interested from your purview of foreign exchange. What do you think of the bond market and what the spread market and inversion signal? Do they signal crisis where we go disjoint or have jump conditions, or do they signal some form of normality?
Well, that's a very good question, and I think certainly when you look at the history of those yield curves, and you can signal this or see this significant degree of inversion, particularly in that US curve, and whether you think that is signaling a real dislocation in terms of economic activity ahead, or whether you think the markets perhaps are becoming have got a little bit ahead of themselves in that particular context. And I think the degree of inversion probably does overstate the downside risks in terms of the macro outlook. We're cautiously of the view that the market is perhaps pricing in a little too much for the Fed because of the the resilience that we've seen into the turn of the year, and we may not see that being maintained, and we see some of those inflationary pressures start to diminish. But I think in the context of the upcoming data releases, and going back to where Lisa was underlining the key events of the day, then I think that that German yield curve, I think, is going to be very instructive, because we are going to see further inflationary pressures, and that's going to keep Eurozone terminal rates well supported, and from an FX perspective, probably keeps Euro-dollar well underpinned as well.
So let's talk about that. That's exactly where I wanted to go. What the market is pricing in right now is significant. A 4% ECB terminal rate at a time when you have inflation running at the fastest pace in decades in modern history in Europe. How much have we priced in the upside surprises that could potentially come from today's CPI data or tomorrow's Eurozone broader read?
Well, I think if we go back to yesterday and we saw the reads from both French and Spanish HICP, those were both of those releases came in on the top side, and the Spanish number was particularly disappointing in the context of the reduction in administered prices that we'd seen. So it does look as though all roads are pointing towards a higher German print than the market's anticipating, and probably also in terms of the Eurozone metric tomorrow. And I think most importantly, we should look beyond just the headline read, but also focus much more on the core number. And I think that's going to be something which is going to become much more relevant for the ECB policy narrative going forward. We saw some comments from Philip Lane earlier in the week regarding the importance of core prices once you strip out food and energy. And those were already at cyclical highs. And if we were to see another uptick or a move higher in terms of core prices, then that's going to only amplify the degree of pressure on the ECB to tighten policy further. And of course, that potentially starts to raise issues, and particularly uncomfortable issues in terms of the context of the ECB, in terms of those fragmentation concerns once again.
So, Jeremy, this is where it stands. We've had about 300 basis points of hikes from the ECB. They were at -50 on the deposit rate. They're now at 250. Goldman Sachs came out a little bit early this morning, and they now think that the terminal rate, the peak rate of this hiking cycle, will be 375 at the ECB. Is that where you're at, 375 pushing 4?
Well, put it this way. I adjusted our terminal rate assumption back in December to 350 for this year. But my presumption of 350 is proving to be increasingly challenged by virtue of these inflationary dynamics. So I think particularly if we do see, as I say, those core prices remaining relatively sticky, then I think the prospect of 375 or higher continues to build. And so accordingly, that underpins our structural bias for a higher valuation of euro dollar through the course of the next 6 to 12 months. And so that's why we're looking for euro dollar to be trading back into the low to mid teens by the end of the year.
Wow. Euro stronger right now, 106. Pushing 9/10 higher on euro dollar. Jeremy, thank you, sir. Jeremy Stretch there of CIBC. The latest from Goldman then, looking for a terminal rate on the deposit rate of the ECB of 3.75. Lisa's friend, the Bank of France governor, was out a little bit earlier this morning. Did you see those comments?
Yes, I did.
I was waiting for you to bring them up. Turned around and said we need to get to the peak rate by September. Just trying to work out what that peak rate will be.
I like that you said my friend rather than trying to say
And then I
his
said
name.
the Bank of France governor.
rather than trying to say Villeroy de Gallo. But
That is beautiful.
Thank you. I always say it slightly differently. But there's a question about what that terminal rate is. If you want to get there by September, that means that March is not the last. And I think that is really instructive at a time where the rate is already higher than many people thought they could get to. And so you do wonder, especially with the peripheral spreads controlled, have we seen the worst of it in terms of being priced into the market?
Well, let's talk about the journey. So 50 basis points this month. That's what most people are looking for. That's what the ECB guided us towards. Goldman says another 50 basis points in May, Tom. And then in June, you have a lift to 375 rather.
I'm going to go Bullard on you here. And what's interesting here is we're now talking about the speed to get there. And I would suggest September. I don't care what the central bank is. In central bank talk, September is basically tomorrow. And this is part of it. A lot of people talking about jump conditions that we're seeing right now in yields, and some of it's a gloom crew. But the answer is, all of a sudden, we're talking about getting there fast.
Meanwhile, ECB's Joachim Nagel saying he won't speculate on when the rate may be reached.
Nagel.
So there you go.
She nailed
Seriously.
Nagel.
When the peak rate will be reached.
It's the same exact issue. He doesn't want to basically double down on that.
I think he wants to
let alone
get there fast, given that he's from the Bundesbank.
And eliminate all bond buying and basically reverse that.
All of the above.
Yeah, the balance sheet
Okay.
right away.
Next now, Mona Mahajan's going to weigh in on this from Edward Jones.
So much love.
Just kidding, this ECB talk, aren't we? Looking forward to that conversation a little bit later this morning. That's about 50 minutes away. Futures right now up 0.33%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In China, the economy is showing signs of a stronger rebound after COVID restrictions were abandoned. Manufacturing posted its biggest improvement in more than a decade last month. Meanwhile, services activity climbed and housing market stabilized. In northeastern Greece, at least 36 people have been killed in a train crash. 85 others have been injured. Authorities say a passenger train collided with a freight train just before midnight, starting a fire. The passenger train was traveling between two popular tourist destinations, Athens and Thessaloniki. Lori Lightfoot has become the first mayor of Chicago in 40 years to lose a bid for re-election. She finished third in Tuesday's election. An April 4th runoff will pit former Chicago Schools Chief Paul Vallis against Cook County Commissioner Brandon Johnson. Lightfoot was unable to overcome voter dissatisfaction with Chicago's rising crime and slow economic recovery. FBI Director Christopher Wray says the agency previously determined that the COVID virus most likely originated from a potential lab incident in Wuhan, China. Wray's comments to Fox News contradict scientific claims that the virus emerged naturally. He said the Chinese government has been trying to counter the work the U.S. is doing in that matter. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Equity futures on the S&P shaping up as follows. A lift on the S&P 500 up a third of 1%, the Nasdaq up 0.5%. Is that the Bond theme tune? Lisa watched her first James Bond movie 6 months ago. Won't stop talking about it.
Absolutely not true. Every time you talk about G-Force, I just think of that one, James Bond scene from Moonraker with... Okay, let's move on with Roger Moore.
No, tell us more. It's great. You're a big,
really
big Roger Moore fan.
The markets are amazing.
How about that bond market? Let's get to it. Your 2-year looks like this. On February 2nd, the day before the payrolls report, 4.03% on a US 2-year. Right now, 481.60. Yields unchanged on the session, not unchanged over the last month. Similar move on a 10-year, 391.43. Yields unchanged on a session over the last month, materially higher. In the FX market, we shape up as follows. We had German CPI a little bit earlier, the regional stuff, just to break down region to region in Germany. Basically looking for German CPI now to come in probably unchanged in about 90 minutes from now when we get the latest read, unchanged from the previous month, year over year. And that's a problem for the ECB, which is why the likes of the ECB and Goldman Sachs and their call, Tom, is 3.75 on the depot rate over at the ECB as a peak rate of this hiking cycle.
And the speed of it. Now, where are we on the Bundesbank? We just had headlines out from Nagel, and it's like sooner.
I imagine they're going to be strategic in the next meeting. We've got guidance of 50 basis points at the incoming meeting this March. Yeah. I imagine the Hawks are going to be driving to get the same guidance for the following meeting to say, we're going 50 again.
This is a joy, what we're going to do right now. And this is, when you hear me talk about Vector, this is where I got it. Jennifer McEwen was lucky enough to learn economics at UCL. And the giant at UCL of the algebra of vectors and economics is Wendy Carlin. And if you study with Wendy Carlin at UCL, that's a good thing. Jennifer McEwen joins us this morning with Capital Economics. I'm going to go right there, Jennifer. I think that there's a real change here in the vectors we perceive of inflation led by Europe, France, Spain, and the rest. Is there disinflation in Europe?
No, not really, not yet. Well, there is in the headline figures. We know, everybody knows that energy inflation is coming down, with the gas price coming down further lately. That should continue. But the core inflation figures are the most worrying, of course. And what we've seen in France and in Spain and in the German states too is services inflation picking up, and that's got to be a real worry for the ECB, particularly at a time when the labour market's still relatively tight.
In your world, is there a study of goods inflation or goods disinflation and services inflation like there is in America? Can you make that partition country to country in Europe?
Yes, you can. And we've had, even from the granular level from the German states, we've had some data on goods and services inflation. We know that goods inflation is coming down. Product shortages have eased pretty dramatically across the surveys, and that's helping to pull goods inflation down. Shipping costs are coming down too. But in services, things seem to be going in the other direction. I think we'd hope, central banks would hope that by now there'd be clearer evidence of services inflation easing off, but that just doesn't seem to be happening.
Jennifer, I remember about a year ago, people said that the nature of inflation in Europe is very different than in the U.S. It's not delivered through the injection of mass fiscal stimulus, but rather it's driven by the energy shock and about the crisis in Ukraine. And now we see it stickier, even though energy prices aren't that elevated. Yes, they're higher than they were 2 years ago, but not relative to where they were 6 months ago. How do you explain this?
Yeah, I think that there's some knock-on effect from the energy prices. So that they were high for a long time. People are feeling the squeeze on their bills. People are pushing for higher wages. It's quite a slow process in the Eurozone to get wage growth up. And wages have been well contained for so long that they're relatively sticky. But there is evidence now that they seem to be picking up, that workers are having some success in pushing for higher wages, and also that firms are starting to push through their higher costs into the retail prices for things like services.
How much, though, does this really defy the logic that the European inflation story is so different from what we see over in the U.S. that is perhaps idiosyncratic and easier to beat than the one in America? I mean, that's basically been the argument at least 12 months ago. Now, has that completely changed? Is this a similar inflation?
Yes, yeah, it's similar. It's just behind. Inflation was slower to pick up in the Eurozone. Both headline inflation and core inflation picked up later than they did in the US, and they'll be slower to fall back too. The wage bargaining process is a bit slower, and it may even be that because of that, because of this stickiness in wages we get in the Eurozone in particular, that core price pressures, underlying inflation pressures are more persistent than they are in the US.
Is this part of the reason why, Jennifer, you see the market now adapting to the idea that perhaps the ECB's terminal rate needs to be closer to the Fed's terminal rate because the inflation picture is actually quite similar to what we see over in the U.S.?
Yes, yeah, I think that's right. We're expecting the terminal rate to be about 3.5%. The market's obviously higher, but I think the risks are to the upside, depending a lot on what happens in the real activity data now as well. What we've seen in the Eurozone surveys recently is some real evidence of resilience as we have elsewhere. So a lot depends on whether the drag from the policy tightening we've already seen and the drag from the squeeze on real incomes feeds through much more strongly into the hard data and whether or not we see that recession that we've been expecting in the Eurozone.
What you and Lisa just said, Jennifer, is acutely important. Are you suggesting that Europe and all of Europe, 17 nations of Europe, 20x nations of Europe, that they have the same equivalent productivity and technology overlay as the United States of America? That we can do a rate equivalency?
No, trend growth, productivity growth is considerably lower in the Eurozone than it is in the US.
Then
so
how
I think
I don't mean to interrupt,
clear.
but this is critical. Then how can we affect an equivalent terminal rate if that's the case?
Well, it depends on the point in the cycle, and I think what we're seeing in the Eurozone is more of an overheating in terms of inflation pressures, at least sort of to beyond where the ECB would want it. The neutral rate is still relatively low, and I think ultimately we're going to be getting back to nominal rates of 1.5–2%. But in the meantime, you may go significantly higher, and it depends very much on what happens in the labour market and what happens to wage growth over the next few months.
John, does anybody at ECB, with all your experience there, talk about our start? I mean, I've never witnessed anyone in Europe wax philosophical about European our start because I just don't think there's an equivalency.
It's one of those fuzzy concepts, Tom, that is really difficult to find. Can you imagine trying to find that in Europe?
I haven't heard, the extinguished people that I talk to. I've never heard any of them.
The phrase we hear a lot, Tom, in the last 6 months is sufficiently restrictive. What is sufficiently restrictive? Now, what will be sufficiently restrictive in Italy will be very different to what is sufficiently restrictive in Germany.
Okay, and
that's been a story for a long time.
But what's sufficient? I'm going to get in trouble here. What's sufficiently restrictive in Mississippi is different than what's sufficiently restrictive in Montana. I mean, in the aggregate, can we sum Europe and do a compare and contrast
So you make the comparison to the US, and I think that's interesting because around the Eurozone debt crisis, there were some people who were thinking out loud, Tom, about maybe reconstructing the ECB to have regional ECB presidents instead of having national presidents, just to try and strip the bias out of things, because maybe the regional makeup of the FOMC is probably a little bit more effective when it comes to these issues.
It is a serious concern, right? Which is, what is the knock-on effects economically to a rate that might make sense for Germany, but not for Italy, not for Spain, right? This is sort of the big concern. And you wonder, and I'm curious about Jennifer's take on this, and Jennifer, can you weigh in? Are we looking at a much weaker Europe going forward because of the damage they have to do to the economy with rates that may be closer to equivalent to the U.S., but are not fit for the production, the productivity that Tom was talking about, or the technological overlay of that economy?
Yeah, the ECB's always had a very complicated job with the various nations and different structures of their economies. And of course, a really key issue for the Eurozone is that you don't have a single fiscal policy which can distribute distribute government finances across the entire region. You've got economies like Italy with very high debt where they just can't offer the kind of fiscal stimulus that would offset the effects of policy tightening. So that's a major issue. And I think another big problem across the Eurozone Eurozone is the difference in the structure of mortgages, where some are much shorter term, variable rates, for example, in Spain. And so you get a pass-through of policy tightening relatively quickly, whereas in Germany, long rates, fixed terms, that pass-through comes much more slowly. So it's extremely difficult to find a one-size-fits-all policy, and it's clearly going to be the case that some economies suffer more than others from the policy tightening.
And this conversation, another example of why we should never have done this. Jennifer McKeown of Capital Economics. That was a joke. I'm not saying that you said that. Jennifer, thank you.
Be careful. She's a proxy friend of ours.
Complaining about European Monetary Union and all that great stuff.
You
Let me
really
finish
didn't
on
go
this.
there. You just throw that bomb out there. And
For
then
the
just move
ECB
on.
right now, it's pretty straightforward, isn't it? Inflation's too high everywhere. You know, it's not like things are dreadful in Italy and fantastic in Germany. They've got to work this out. It's pretty straightforward now.
Right, but I guess that, and you're absolutely right. That's the issue, is that they have to take a blunt tool to a serious problem that does not seem to be abating. The issue now is, what is the economic consequence, and how bifurcated is it between different economies with different inputs? I would argue perhaps they're not as disparate as they have been in the past, based on some of the challenges that Germany has been experiencing in a way that is unique.
Well, Jennifer touched on it. I think when it comes to debt, it's a very different experience right now for Italy, Tom, with rates where they are, compared to Germany with rates where they are.
That goes back to the fiscal separateness of Europe versus maybe a fiscal uniformity in the United States. Let's make clear that there are Euro optimists that think long term that Europe can do an aggregate economy better than the United States. But are we there now? I'm not sure I see evidence.
I think that remains to be seen.
Yeah, I don't.
We saw maybe a couple of examples of going in that direction in the pandemic, but once the crisis fades,
there's a war going on. I mean, you got to wait. I don't think now's the time to do a study of that.
You can talk to James Athey about it if you want. He's going to join us at 7:30 Eastern time. Do you want to name the firm? I know you love doing this. You've got this. Go on. Where's James' work?
For 2023, I think they're going back to Aberdeen.
Aberdeen? Oh, you think the Vals come back?
Right now they're in Aberdeen. Which is sort of like how Lisa pronounces the French banker. But.
Can you imagine the conversation that took place when Aberdeen Asset Management sat around the table and they had the marketing people in? You just know they paid for someone to come up with this, right?
This is how you appeal to the millennials. Just shorter, just remove the back.
I'd love the backstory to that. Like the meeting. I just want to know the meeting. Put it up on a board and said yes.
We all have. I'm going to center my first idiocy of this with Jerry Tsai. The American Can Company wasn't good enough, so they named it Primerica. To this day, I'm not sure I know what Primerica means.
What I love about situations like this is that the C-suite goes away and makes this big decision for the rest of the company. They all feel really happy with themselves, and then the employees, they get the memo, and they're like,
was it Philip Morris went Altria?
For goodness sake.
Yeah.
Speak to some people at Aberdeen, and they're like, no. Don't talk to me about it. But James is going to join us.
Remember to...
We hope.
He's not going to cancel.
He's a proxy friend. He's got to join.
7:30 Eastern time, 50 minutes away from New York. This is Bloomberg.
Look going.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. U.S. businesses are set to invest billions of dollars in Northern Ireland. But that's only if the deal on post-Brexit trading regulations leads to political stability in the region. British Prime Minister Rishi Sunak could use the prospect of international investment to help convince Northern Ireland unionists to back that deal. In the UK, the cost of living crisis showed little sign of easing last month. Prices in British stores rose in February at their highest rate since at least 2005. The British Retail Consortium said shop price inflation hit 8.4%. Food prices rose even faster, 14.5%. In Ukraine, President Volodymyr Zelensky said the battle in Bakhmut is the most difficult situation facing the country's forces. He said the intensity of fighting is increasing. Ukraine has decided to send additional troops to Bakhmut to try to stop the Russian offensive. China's President Xi Jinping has moved to consolidate the Communist Party's hold over the economy. In his speech today, Xi touted plans for sweeping changes to the country's bureaucracy. The party will also have more influence with private companies. And shares of electric vehicle maker Rivian are lower today. The company's forecast to produce as many as 50,000 EVs this year, it fell short of Wall Street expectations. Revenue came up short, too. Rivian says supply chain issues are the main issue limiting that production. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The big event last year was not Russia, it was China. I mean, global oil demand contracted 2% in the fourth quarter of last year. That's a recession in my book. As China comes back, we're going to lose that spare capacity. Our base case is, we get into the fourth quarter, towards the end of the year, we get back above 100. My confidence that we'll see another spike in the next 12 to 18 months is quite high.
Still looking for triple-digit crude by year-end. That was Jeff Curry of Goldman Sachs, live from New York this morning. Good morning. Here's the price action for you. A quick sneak peek of crude right now. Crude softer, negative on WTI by 0.9%. Call it 1 full percentage point lower, 76.30. In the bond market, yields unchanged, 391.62. And equities with a little bit of a lift here. TK up 1/3%. Lisa went through the data that comes out a little bit later on the US side of things. China PMI is pretty decent relative to expectations. Upside surprises across the board.
And with the weakness in EM, Damien Sassar to join the next hour. John, yuan, 6.86 yuan. I'm going to call that some stability there. We haven't weakened out to 7 yuan per dollar.
That's some strength in the Chinese currency this morning off the back of that data. And we mentioned it a little bit earlier this morning. The surprise, according to our reporting from Chinese officials, about how well that reopening and how good the data is.
Yeah. Well, we're going to do that right now with Enda Curran. He's our Asia economics correspondent, but far more than that, has terrific anecdotal wisdom on the Pacific Rim. And we've got a lot of serious questions, but let me go to that bridge to China from Hong Kong. It was built in 2007 and changed everything. Is there enough of a reopening where the corridors, the western corridors from Hong Kong to the rest of China are quote-unquote normal?
Well, the reopening is going better than expected, Tom. The economic data, the numbers we had today were the first decent read we've had on the economy since the reopening, and it does show that it's better than has been expected. A PMI of 52.6%, not just about consumers and services, but also about the manufacturing side, and certainly a big part of that is the southern part of China, the Guangdong region next door to Hong Kong. So Hong Kong is picking up on some of that. But I think the broader backstory is that the economy is now setting itself up for a much better year than it was anticipated only at the back end of last year. Remember, growth forecast last year were heading towards 3%. Well, now hardly a day goes by without my inbox getting an upgrade from somebody, and people are expecting a growth target of 5% or more now.
My amateur take is watch the property market, and is that true? And is it once again Beijing is bailing out the national property market?
I think it's quite true to keep an eye on property, Tom. It's not really at a bailout, though. The property, actually, home sales, we had data today showing home sales improved on year for the first time since the middle of 2021. That is significant because the slump in the housing market arguably caused more pain to the economy than COVID-0. So there are signs of a bottoming out there. There is, of course, official support behind that. The authorities are pulling levers. I wouldn't quite call it a bailout in the Western sense. They are imposing some pain there, but nonetheless, there is a turnaround, and a lot of economists are pointing to that as one of the reasons for their optimism.
And is there any connection between the much better than expected economic data coming out of China and the seemingly emboldened approach in terms of China's potential willingness to engage with Russia and its allies on the war in Ukraine?
Well, you'd have to say that China's economy was on its knees into the end of last year. Lisa, there's going to be a very important political meeting kicking off from this Sunday, and they're going into that with some pretty decent economic data behind them. I mean, the mood music is a lot better, as I say. It's not just the consumer side of things. Hints of manufacturing picking up today as well. Employment indicators looking better there. All of that speaks to, China getting back on track, getting on its feet, and of course that will bolster its position on the world stage. Now, I don't think it's completely feeding into its position on Ukraine per se, but it certainly won't do the leadership any harm in terms of when they do want to stand on the global stage and reinforce the point that they handled COVID better than anybody else.
Socially, is the recovery that we're seeing so far enough to garner the support for Xi Jinping, for the leadership of China in the way among the population that they'd wish, amid some actually public dissent that we've seen that's very unusual in China?
Very unusual. Lisa, we did have some reporting this week ourselves picking up on the level of dissent on the ground, especially in the wake of those draconian COVID-0 policies. Well, it's difficult to be scientific about consumer or public opinion across China, but there's no doubt there is a feeling of disaffection. That was part of the reason why the authorities made the turn that they did on COVID-0, and as rapidly as they did, and the authorities were more than cognizant of what was going on the ground, given those punishing lockdowns and ongoing restrictions. And by the way, the American Chamber came out today and they were making the point that foreign companies up there are just exhausted about what's been going on over recent years. So there is this disaffection on the ground. It's just very hard to be precise about the extent of it.
And can you speak to that directly? How has life changed for you in the last few months in a place like Hong Kong?
Well, it has to be said, it's night and day compared to what it was when we were doing COVID-0, John. I mean, the airport has reopened here. It was one of the world's busiest. The crossing into Shenzhen has reopened. That's crucial for trade, like Tom was asking about it earlier on. And of course, on the ground, things are better. We just had that face mask rule lifted yesterday for the first time in 3 years. But Hong Kong, as one example, is still nowhere near what it was before the pandemic. The level of activity and visitors and tourist arrivals and all of that is not what it was. It has a long way to go. And it's not just COVID-0. There's a feeling that Hong Kong is caught in the middle of the geopolitical tussle between China and the US. It's on a geopolitical fault line, if you will, and that's really weighing on the recovery here.
And do you think there are some things that have been lost to places like Singapore just forever that will be hard to recover from?
There has to be, John, compared to what Hong Kong was a few years ago in terms of visitor arrivals, conventions, conferences, events, people coming here back and forth and all of that. Some of that business has leaked to Singapore, both in terms of personnel and actual business, no doubt. But Hong Kong's business model remains that as long as Shanghai is behind a closed capital account, well then Hong Kong's business model remains, it is the money box for China. It's the place to do business if you want to do with China, and that part of the equation hasn't changed.
And thank you, sir, for your reporting.
Very brief.
Just fantastic, as always. And Karen there out of Hong Kong. TK, we had those conversations a couple of years ago here in the United States. What would change? What would remain the same? What would go back to a pre-pandemic trend? We're still having them here in the US, but they're just beginning to happen over in Hong Kong.
They're behind on that, I'll admit. But, I go to the resiliency of what they've done as tiger nations. And, of course, the unique experiment of China is they've had a lot of other equally as big challenges over the last 20 or 30 years. I just... I don't want to pontificate about a Pacific Rim resurgence, but certainly that's modeled in. And I would look at the back of some of these oil reports. We had Jeff Curry on earlier coming into the block, and these guys are looking at $100 oil, and I would suggest the one or the two factor in that is a Pacific Rim redo.
So Ender mentioned supply chains. I think supply chains around the world all got a major stress test over the last 3 years. We all know that. We're now talking about undoing globalization, deglobalization. That process, if it does start to begin in a major way, is going to come with a price, Lisa. We've got to work out how expensive that's going to be.
This is actually one of the most salient arguments, I think, about more protracted inflation, is if you do reverse even part of the globalization wave, or even if you just don't have that globalization headwind to keep prices low, then you're going to see some higher prices. You're going to see more price pressure. You're going to see more labor issues as you try to get some of the workers if you don't have the factory to the world in the same kind of way. Did you see that anecdotal report about the AirPod manufacturer saying that they're going to move some of their manufacturing out of China, that some of Apple's own manufacturing units are doing this? So you see this on the margins. I don't know if it's enough to be more than just anecdotes, but that's
Lisa,
the fear.
Under my living room couch, it's Life of FIFO AirPods.
You've got your own Foxconn.
Okay, last in, first out, first in, really last out, whatever. There's got to be 20 pair of AirPods under my living room couch. I mean, what a racket. What do they cost? They don't let me know what they cost.
What's the racket? Is it that
the
you
AirPods,
keep buying
I keep
them?
buying them.
20.
You don't know how
so where are they made? They're made in China. Everything's made in China.
Yeah, it depends if you get the Ultra Pro or something like that.
Are they made in China?
Well, they're being.
And now where do they want to move the manufacturing? My living room.
Yeah, exactly, under your couch. I suggest, if you lift the couch up, you might save yourself.
Can you imagine that business alone,
yeah.
the AirPods? If it was its own company, would just be huge.
Oh, this is some of the parts on Apple.
It's nuts.
Scary.
It's crazy.
Most of the sell-side crew won't do a legitimate sum of the parts because the number is so high they don't want to be associated with it. Literally. I'm not kidding. From a compliance standpoint, you don't want to put that number out there.
What's the number? You can do it.
I don't have it here. It's ginormous. It takes services. Forget about AirPods. Just take the services part.
Do you not go through your credit card statement to look at what's been spent on it?
I have children, John. We don't go through the statements.
You don't go through the statement? I thought people with children did do that.
No.
I do that.
Monetary tightening is not taking a bite out of the economy. This is bad news for inflation and bad news for the markets.
At some point in the future, we will see inflation coming back down to target.
We think that headline inflation is going to fall back to around, possibly just under 3.5% by mid-year.
There's no sector of the economy that really is hurting.
This is an environment with very heightened macro and market volatility. We have to change our views very quickly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Let's get the month of March started for you. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures positive, 0.33%. Some data out of China, Europe, data out of the US, Tom, still to come.
Constructive lift there. The important data here, John, I'm going to let you talk about it because you care more than I am. This data, March 1 here on a delayed jobs report, I'm sorry, it's a big deal what we're going to see at 10 o'clock.
Well, let's talk about what we're going to see at 8 a.m. as well, about an hour from now. You're going to break down a German inflation going into the Eurozone print tomorrow. So far, so bad for the European breakdown of CPI, Lisa, at the moment.
What we've seen from France, what we saw from Spain, going in the wrong direction. We see that in Germany. All of a sudden, what do you start gaming out? I mean, we heard from the Bundesbank this morning talking about possibly winding down the balance sheet faster. What kind of ramification would that have at a time when we're just starting to think about a world without zero rates?
We discussed also how complicating it might be to have China reopening at the same time we grapple with all of this. That process has only just started. We've only just started to see a real bounce in the PMIs. So that bite for growth we're set to see later this year. That's not in commodities yet.
Yeah.
Look at crude. Crude's flat on the year. Jeff Curry of Goldman talking to Francine earlier this morning, Tom, talking up triple-digit crude still year-end.
This is really important, what you just said about the time continuum. We've only just started. And the answer is, as someone said this morning, I think it was Ben Laidler, we're 2 months in on a 12-month year. And, we're going to reframe in May. We're going to reframe in August. And we'll talk to Mona about this here in a moment. But, I'm sorry, the idea of making big views out to the end of summer, it's not long-term, out to August, ain't going to happen.
That's long-term.
Long-term
like
is August.
Months.
And, who's brave enough?
Well, let's talk about the first 2 months of the year. They couldn't be any different. January and February. January, we're talking disinflationary process may be starting. February, cold water, freezing cold water at the start of the month, all over that.
To show you just how much this is the case, we saw the best January performance for bonds for the aggregate index in data going back to 1990, and now we just saw the worst February performance for the aggregate index going back to data in 1990. That's the whipsaw we've seen in terms of inflation expectations.
Is that the Bloomberg ag?
That's the Bloomberg ag.
Let's call it that,
the
Bramo.
Bloomberg aggregate bond index.
Sell the product, Lisa.
Nice.
Thanks, I appreciate it.
I'm looking at it, not Fibonacci here, but we didn't make 50% back. We went down on price. Terrible bond market last year. We came up, John, in a bounce, and we came back about 45%.
This equity market did too. Futures trying to bounce by 1/3%. Here's the price action for you on the S&P 500. A little bit of a lift. We're going to talk about the data you're going to get a little bit later. Lisa's going to go through that for you. The bond market unchanged. Your 10-year 3.92 in the FX market. Lisa, euro dollar 106.64.
So let's talk about what we're seeing and what we're expecting to see. We talked earlier this morning about some of the retailer earnings. We already got some of them. We got Lowe's. It basically met expectations. You're not seeing much in pre-market. Kohl's just came out, and they came in disappointing pretty much across the board in terms of gross margins, in terms of what we're looking at in terms of revenue, as well as their forward forecast. They're seeing a loss, and those shares are lower by more than 11%. It highlights how hard it is to get ahead of some of these stories. The whipsaw action we've seen before in terms of before and after some of these earnings has been tremendous.
I mean, you're looking at me. I've never been to one. What happens at Kohl's?
Well, somebody wrote in and said that everyone is just using Kohl's as a glorified Amazon return center. I'm not saying that.
Is that what they're using it for?
I'm just, there is this concern if you can't identify what your role is as a sort of lower price.
Well, the hope was that you'd go
retailers.
back, return stuff, and then you'd buy things. right? Wasn't that the hope?
I went into a retailer that I'm not going to mention, and there was a line
You are going to
out the door. It was H&M, and it was,
Right.
it was all people doing returns, online returns in the store. Our storefronts becoming return centers for what you buy
Well, we heard that.
online.
That's just the whole baloney. I've always hated the word omnisphere. It's sort of like, what's the vogue right now? I can't remember what it is.
Omnichannel.
Omnisphere, omnichannel.
We live in
whatever.
an omnisphere.
Thank you. Kohl's, let's talk about it. These are family-run businesses. Many people on the sell side would suggest they should have been rolled up years ago. They're out of Wisconsin, 35,000 employees. Kohl's is a venerable Midwest retailer that's gone nowhere for 10 years. Total return per year, negative 1.2% per year. Why are they publicly traded?
It's going somewhere now. It's down 11%, Lisa.
And we'll follow that throughout the morning. Just quickly, we also get German CPI. We've been talking about that for the month of February at 8 a.m. What is the response going to be at a time when two-year yields over in Germany are at 3.2%, the highest level going back to 2008? And at 10 a.m., the U.S. ISM Manufacturing and Prices Index for the month of February. Do we see a reacceleration there, John? That's really going to be a big question.
Just the number one question, isn't it?
Yeah.
Going into payrolls on Friday.
Absolutely.
Next Friday. Does
Next
it confirm
Friday,
what we saw
like 8 days away
a month
Friday.
ago? Yeah, you're going to be around for that? You coming in?
I'm here for that. I'm not here for the
Nice.
Fed meeting.
You're skipping the Fed.
I'm skipping the Fed meeting.
Why are you doing that?
Because children rule.
Okay. And they
Dads
demanded.
drool.
They demanded that you skip the
This
Fed.
is like, you get like, John, with each kid, you get like a window a year or 2 windows a year.
Okay.
And that's
I'm aware
a
because I was a child
I
once.
called up
and we
Chairman
did that,
Powell.
Tom.
I said, well,
took
actually,
vacations.
Or I thought you said lobbied parents
Tom
not
just
to
thinks
go in
I've
for
been
the
this
Fed
age
meeting.
permanently.
Exactly, you've been permanently.
Wasn't aware that children take time off.
You
Thanks
were-
for that, Tom.
You were born in a suit.
That's helpful. Mona Mahajan joins
You're
us now.
learning every day.
Senior investment strategist at Edward Jones. Mona, let's start with this equity market. You like quality growth. What is quality growth?
Yeah. Hi, John. Thanks so much. Look, I think we started this year looking at a market that was driven by better than expected economic data. We saw a strong January jobs report. We saw better than expected retail sales. And we certainly saw inflation, at least towards the back half of last year, starting to move lower. But I think the trade into what we'd call more cyclical parts of the market probably happened too fast, too soon, earlier on this year. So to your question, as we get through this year, we need to see a couple of things before we can kind of revisit that recovery playbook or that cyclical playbook. We would still need to see, one, of course, inflation move meaningfully lower. Two, we'd like to see the Fed actually step to the sidelines at some point, probably middle of this year. And then three, we are starting to see earnings being revised meaningfully lower at this point for 2023. We haven't seen that bottom yet. So until those conditions are in place, we'd say probably the market is going to take a more defensive tilt. We could see continued volatility. But at some point, when those conditions are met, maybe towards the back half of this year, we do think that investors should think about diversifying into those more recovery parts of the market. That includes quality growth. That means growth that is not negative earnings yielding, probably not as speculative parts of the market. And then, of course, areas like cyclicals, even parts of small caps, international could be interesting as well. So all part of a recovery playbook that could happen down the road.
Mona, you've got a wonderful single sentence in your note, which I totally agree with, which extrapolation right now is very dangerous to your net worth. If it's an extrapolate-free 2003, if you have a faith to be in the market, how far are you reaching over to the next horizon? Are you looking out a year? Or dare I say, is the new extrapolation out to 3 years?
That's interesting, John. And to your, Tom, sorry. And to your point.
It's okay. You can call me Lisa as well. That's happened as well.
I love all three of you. So I do
Glad
think
someone does.
January data, it's very dangerous, as you noted, to extrapolate the strength we saw, certainly in the labor market, certainly in the consumer to the rest of the year. Keep in mind, the labor market does tend to be one of the lagging indicators. We have leading indicators, we have coincident indicators, then we have lagging indicators. And the labor market tends not to usually be the first shoe to drop, but perhaps towards one of the last shoes to drop. But to your question on time horizon, we do still think a 12-month time horizon, although we've been talking about 12 to 24 months, because that's really when we can see this cycle go through a bottoming process, and then markets can then start looking towards a recovery process. And we do think, investors have a very unique opportunity in the 12 months ahead, in that, we know bear markets don't happen all that often, one every 4 to 5 years. But in history, the good news is every bear market has ended and every bear market has been followed by a potential bull market. So when we look out 12 to 24 months, we do think investors are positioned for better opportunities ahead.
What's the leadership going to be in that next bull market?
Yeah, it's a great question. And look, I think when we look at the last 10 years or so, the 10 years after the financial crisis, that was an environment that was characterized by Fed funds rate towards the zero bound. Growth outperformed value for much of that period because investors were pushed out the risk spectrum. When we think about the next 10-year period or so, we don't necessarily see yields back at the zero bound. Certainly, the Fed funds rate could go from this 5.5% back to more neutral territory. But in that environment, we do think investors have to consider a balance between value and growth and think about a more diversified picture and leadership going forward. So that's interesting for the next longer term period. I do think over the next 12 to 24 months or so, we think we'll go from a more defensively oriented tilt to a more offensively oriented tilt. As we noted earlier, that recovery playbook does come into play.
Mona, when we use this word defense, I discussed this yesterday. I'd love your insight on it. It'd be hugely valuable to me. Defense is usually just what works when things are bad. And last year, defense was energy because that's what worked when things were bad. Mona, what is defense in 2023?
Yeah, and it's a great point because energy is not usually always the defensive part of the market, but we think more traditional defensive sectors, healthcare, staples in particular, if we do go into any sort of economic downturn, slowdown, those sectors which have underperformed thus far this year, we may see some interest and some more leadership come out of that more traditional recession-proof and even to some extent inflation-proof part of the market. What's interesting, I think, this time around, defense is also your shorter duration CD 1 to 2 year Treasury bond space as well. Of course, what's notably different this cycle is that cash and cash-like instruments are yielding anywhere from 4 to 5% plus. And that is an environment where, if investors do want to hang out, think about a recovery playbook, but in the meanwhile, put their money in very attractively yielding assets, that is a place that we're seeing a lot of defense right now.
Mona, this was great, as always. Mona Hajan there of Edward Jones. Mona Mahajan on defense and basically cash and the 5% yield you can pick up on it. Up next on the programme, we're going to talk about China and these comments from the FBI Director, Christopher Wray, who was speaking to Fox News just last night and said this: the FBI has for quite some time now assessed that the origins of the pandemic are most likely a potential lab incident in Wuhan. That conversation coming up shortly from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Bank of England Governor Andrew Bailey is signaling that further interest rate increases may be needed to contain inflation. Now, in his statement, Bailey said that doing too little now may mean sharper rate hikes later. He said the experience of the 1970s taught that lesson. In China, the economy is showing signs of a stronger rebound after COVID restrictions were abandoned. Manufacturing posted its biggest improvement in more than a decade last month. Meanwhile, services activity climbed and the housing market stabilized. FBI Director Christopher Wray says the agency previously determined that the COVID virus most likely originated from a potential lab incident in Wuhan, China. Now, Wray's comments to Fox News contradict scientific claims that the virus emerged naturally. He said the Chinese government has been trying to counter the work the U.S. is doing in that matter. Lori Lightfoot has become the first mayor of Chicago in 40 years to lose bid for re-election. She finished third in Tuesday's election on April 4th. An April 4th runoff will pit former Chicago Schools Chief Paul Vallis against Cook County Commissioner Brandon Johnson. Now, Lightfoot was unable to overcome voter dissatisfaction with Chicago's rising crime and slow economic recovery. And Lowe's forecast annual profit that met Wall Street estimates. The home improvement retailer took a cautious approach in the midst of shaky conditions in the housing market. Lowe's comparable sales unexpectedly fell in its most recent quarter. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The FBI has for quite some time now assessed that the origins of the pandemic are most likely a potential lab incident in Wuhan. I will just make the observation that the Chinese government, seems to me, has been doing its best to try to thwart and obfuscate the work here, and that's unfortunate for everybody.
Christopher Wray, the director of the FBI, speaking on Fox News. That's something after the report we had over the weekend, Tom, from the Wall Street Journal. Remember that one, that the U.S. Energy Department has also concluded that the pandemic likely arose from a lab leak.
You know, we talked to Andrew Pekosh of Johns Hopkins yesterday, Paul Sweeney and I, and it was really something to talk to somebody, you know, from another time past, John, about this. And what's the efficacy of going back and look at these horrific skeletons in the closet from 3 years ago? It's a huge debate. And yet, at the same time, if this is correct, it's still appalling if it leaked out.
Absolutely.
It's just appalling.
I think what's amazing about this is the amount of different agencies across the US government right now that have different views on this. The Journal spoke to that over the weekend. So you've got the Energy Department and the FBI saying the virus likely spread via a mishap at a Chinese lab. And then the WSJ Wall Street Journal goes on to say 4 other agencies, along with a national intelligence panel, still judged that it was likely the result of natural transmission. 2 undecided. If you're the president right now, what do you say about this?
What you say is you needed more information. Perhaps this is a way to lobby for more access to some of the labs and some of the on-the-ground facilities in China, but I don't know the answer to that. And the question is, how is it leaking out in this capacity? What's the goal of that? And then what is the consequence of that from a policy perspective?
I think you're dead on. It's like, what's the goal of it? I go back. I remember being in Washington as Henry Paulson, his Treasury Secretary, literally had the first conversation, business meeting with the Chinese. I think I can sum it up by saying it was a complete failure. Do they want to talk to us about this?
Well, the frustration that people have, Tom, is that this was a question that people asked during the pandemic, and it was shut down. And it was a conspiracy theory. And now there are agencies within the US government publicly discussing what was once considered to be a conspiracy theory. And I think the frustration other people also have is that most of government wasn't open-minded about where this was coming from when you heard from US officials at the time.
It is political, which means we need to speak to Anne-Marie Horton. She's our Bloomberg Washington correspondent now. Anne-Marie, just an open question with your great reporting and reading the zeitgeist down there. Where is this heading? Where are we in 1 week or 1 month, or dare I say 1 year on the mystery of the beginning of this pandemic?
Well, I think you guys really outlined the fact that there just is no consensus across a variety of U.S. agencies about what exactly happened. I mean, this really goes down to the issue that when there was the pandemic outbreak, there wasn't these independent researchers that were allowed into that Wuhan lab. So when some scientists come out or some agencies say that this was a natural causes, there's a lot of individuals who are critical of that because the access at the very beginning. So there's just still a lot of questions. Jake Sullivan, when he was asked about this, the president's national security advisor, said it was the Biden administration, the ones who actually got the Department of Energy involved as well into looking at this, because they're the ones that control all these labs. So they will say that they are the ones that want a diverse views across the government to make sure that they get to the bottom of this. But the fact of the matter is, when Avril Haines released that report, it was just inconclusive because these agencies cannot all agree.
The U.S. agencies can agree, but I don't see one iota of interest of the Chinese to act within the scientific community on virology. Am I right on that?
Well, they definitely did not want to have these independent researchers come into their backyard, into the Wuhan lab. What they say is that this should be scientific, and they think that when the U.S. points fingers at a potential mistake at this lab, that they're politicizing it.
Well, does this highlight the political nature of the lack of scientific process, to John's point that he was talking about earlier, if certain claims are rejected outright and just cast off as a political, smokescreen rather than something that could be legitimate as comes to the fore later?
Yeah, and I think follow on this, if we continue to get either more comments from the FBI or more reporting about what the Department of Energy was able to find as they were brought into the conversation and to the analysis of what went on, there'll be a lot of questions about I think, about the United States in terms of their support and funding for the World Health Organization. And I think that's probably where this story goes next.
Please elaborate. What do you mean? How is this going to be used to justify some sort of change in the support the U.S. gives to the World Health Organization?
Well, I think the World Health Organization has, for the most part, really has ignored some of these concerns about potentially this started in a Wuhan lab. Obviously, the Chinese government is also part of the World Health Organization, and I think many people will think that there will be criticism that they did not act appropriately and really get to the bottom of what happened at the start of the COVID pandemic.
What's the alternative in terms of the potential consequence that the U.S. could create to say, if you don't comply by these rules or allow for this type of transparency, we will do X? What is that X?
Well, I think you'll hear a lot of politicians probably use this information, whether or not it's the Energy Department or the latest comments from the FBI, to enact more tougher stances, whether or not it's business or based on humanitarian issues, human rights issues with China. I think they will use this to feed some potential bills or maybe export controls, whatever it is, against China. That's what it'll be used. But I'm not sure that the U.S., if they do not have a conclusive final understanding of what actually happened, and you have all these, these are a number of agencies that do not agree, it's going to be very difficult for an administration to take a definitive approach to this.
John, jump in here, because I think you've read in more on this than I have. On a probabilistic determination basis, good people are going almost like the Fed minutes, sure, some, several, whatever, but they're setting up the probabilities. And the answer is, to use a statistical word, I'm hearing we have a real dearth of confidence in our guesstimates on this.
Well, even the Energy Department in the Wall Street Journal story, I think in the 4th or 5th paragraph, says that judgment was made with, quote, low confidence.
Yeah.
But as for working all of this out, I think it's pretty obvious. Countless lives lost. It's cost the global economy trillions of dollars. And I think if you had an accident anywhere that cost you thousands of pounds, thousands of dollars, you'd want to know how that accident happened, wouldn't you? Shouldn't we be a little bit more keen about finding out what on earth happened here?
I would like to see more clarity on the process that different groups are coming with the conclusion from, right? So what is the process that people are using that are finding different conclusions, and what evidence are they all using? Are they deriving this from? Or is it consistent evidence, right? We don't have any visibility into this, which goes to your
it's
point.
top secret,
Why don't we have a sense of that?
It's like a spy
but it's
movie.
not, because it's coming out in terms of the conclusion. So what point do you release some of the information so that the public can judge for themselves?
And trust the government again. You have to remember that we've gone through this long process through the pandemic. Initially, remember, we were told that the masks don't work, don't buy masks. But actually, we needed the masks for the healthcare workers. So then all of a sudden we needed to wear masks, and then you had to wear masks all the time. Then you don't need masks. Lisa, some of the things that we were told, people were lied to. And that's the problem they have with this kind of information as it pours out.
I would completely agree with you. There's also the issue, though, of some sort of precondition that you have around some of these conclusions. If you don't have all the evidence that come out, what some of the ramifications could be before you actually have the evidence, right? So it's a very fraught situation because of the political tensions that go more broad. And that, I think, is really underpinning perhaps the reticence on different sides or the political motivation on other sides to push certain ideas forward.
I think the story's not going away anytime soon.
I think that you're right.
Anne-Marie, down in Washington, AMH, thank you, as always. If you are just tuning in, we need to pick up on what's happening in markets as we kick off the month of March and look ahead to some economic data in about 35 minutes' time. German CPI. Then after that, 2 hours later, you'll get a fresh, brand new ISM manufacturing read on the month of February. February important. We want to work out whether the robust nature of the US rebound in the month of January will be reflected in any way, shape or form in the economic data for February. So that's a February ISM, just some survey data for you. Then it's on to next Friday, not this Friday. Tom, looking ahead to payrolls just around the corner.
I'll take your point. Payrolls is a huge deal, but I got to admit, when's Germany come out? It comes out here like in an hour.
34 minutes.
34 minutes. I'm sorry, it's inflation-centric study right now. Jobs, yeah, it's going to be important, particularly off the oddity of the boom seen 30 days ago, but I'm sorry, inflation matters, and that I believe it's March 18th. I can't remember when the inflation report is. This is a big deal.
James Athey's coming up from Aberdeen. I'm told he's still going to show up in about 4 minutes, so looking forward to that. This is Bloomberg. 7:30 in New York. Equities look a little something like this. A lift, a bounce. We're looking for one anyway after a month of losses in February. Equity futures up by 0.25%. On the Nasdaq 100, we advanced by 0.4%. Last month, remember we were told repeatedly coming into 2023, the correlation between stocks and bonds is going to break. And then it didn't. Bonds were down. Equities are down and yields were up. Yields are up again by a basis point on a 2-year, 4.83. On a 10-year, up a basis point or two.
Nice.
Tom's 3.93.57 on a 10-year yield.
Rounded up 394. I'm sorry, we're still close to 4%. And you think about the economic data that can get us to some drama here, which I think people are starving for, up or down. And the idea, how far away are we from real drama when I come in and see 2's10 spread out to new wides, negative 91 beeps?
Wait for the ISM in about 2 hours and 30 minutes. And get a flavour of things for the month of February, for manufacturing at least.
I can honestly say, I mean, things became fun in 2007. It was boring before that. I've never seen a time like this, John, where everybody's hanging on macroeconomic blah, blah, blah like we are now. I've never seen it
I think
this.
The consensus, Tom, the narrative around the macro blah, 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 shifts from day to day, week to
hour
week.
to hour.
And certainly shifted month to month, January into February.
Okay. Can we talk about? Are you going to do a reader into this, John? Or
no? What's going to happen?
Individual names.
We can go through the rundown very quickly.
No, we can do individual names.
I'm going to have a look at foreign exchange.
I'm just fired up.
Then Lisa's going to go through some single names.
Okay,
right?
I'm looking at Joe Elliott and Flea. Okay, thank you.
And someone in your ear is going to tell you in a moment.
Okay, thank you.
Let's pull up foreign exchange. Quick look at euro dollar for you. Thanks, TK. In about 30 minutes, call it 29. You get CPI out of Europe, Germany, just around the corner.
Argentinian peso.
Euro dollar 106, Lisa 79, and having a decent session as ECB officials talk up some big moves.
A lot of people are looking for that euro to go a whole bunch higher. What I'm looking at in terms of single names, Rivian came out yesterday after the bell. That was supposed to be a competitor with Tesla. It is not, evidently. At least the forecast deliveries are falling short of expectations, and they're still losing money on each of their vehicles that they're producing. Remember when they used to basically take people's money and say that they deliver in like 2 years, and that was part of the issue? Those shares lower by 8.7%. Tom, did you want to weigh in?
One drove by me the other day.
You saw one in the wild?
It's a beautiful car.
It is a beautiful car.
It's a beautiful. I just 40 to 20 after visiting 10. I mean, is it like the new Tesla? I don't get it.
Part of the problem has been that they are trying to lose money on each car to basically generate enough critical mass in the market, and they are not being successful in doing that. That basically has been the takeaway, and this has been a warning that Elon Musk has put out there, and there is some feeling that perhaps there is a bit of indication based on their latest results. We shall see. Lowe's also came out meeting expectations. Those shares aren't necessarily moving around all that much, basically flat, but Kohl's really is where I'm looking at, because if you take a look and dig through those earnings, not only did they talk about gross margins that were well below expectations in the fourth quarter, but their full year forecast was very low. They talked about the potential for withdrawing guidance again. This is what happened last quarter, citing macro pressure. They basically see earnings of $2.10 to $2.70 a share for the full year versus the estimate of $3.20. Those shares, John, down 49% over the past year, just to give you a sense of the concern around this company that are both macroeconomic but also somewhat idiosyncratic.
What did our friend call it a little bit earlier this morning? What was that phrase? A glorified
Amazon Return Center?
Glorified Amazon Return Center.
That was
no one wants to be called that.
No, but I do wonder how many of these brick and mortar stores that haven't necessarily created a reason to exist are becoming return sales.
I would put this across all sectors.
That's great. They've got to create a reason to exist. I mean, you know things are bad when you're sitting in the boardroom trying to work out a reason to exist.
Just to be honest, okay, there are a lot of activist investors involved with Kohl's as well, trying to create, basically
come up with a reason to exist.
Carry on.
That is brutal, isn't it?
My theme this year is the zombie roll-up, and they're part of it. I mean, I won't mince words. It's every sector, John. It's not just retail. Retail's visible and all that, but
my theme is my reason to exist. Let's carry on. Let's go to James Athey.
Nice.
Let's go to James Athey to save the hour. He's investment director at Aberdeen. Thank you, James, for joining us. Now, you've got some wonderful perspective that we're hearing from many others about the inability to predict forward. How do you go about it now day to day to not so much adjust a portfolio, but even maintain confidence in your existing portfolio? How do you process that day to day, hour to hour?
Those conversations in the Coles boardroom about reasons to exist sounds like perfect segue into my attempts to forecast the future and manage the risk associated. Yeah, it's difficult, Tom. It's really difficult. You guys have already talked about it. The complete about face between January and February. When I spoke to John a few weeks ago on his show, I called it narrative tennis. And it's very much been the case over the last 3 or 4 months that just doing the opposite of the prior 4 weeks has been a very profitable strategy. And just given the nature of markets, how low liquidity tends to be, how many systematic and kind of technical traders there are on a daily basis means that momentum is pretty weaponized. So it's difficult, Tom. You try and take a long view. You have to be disciplined. You have to respect market price action. That largely means managing risk without necessarily giving up on your core view. So I'm still medium term of the opinion that this monetary tightening will see the economy suffer in the future. So I want to hang on to some sort of duration view, but I need to manage that accordingly.
James, David Page over at AXA has the same idea as you, and the word he uses is asynchronous, that some people will win within our narrative tennis. And I look at Chevron with a massive buyback, LVMH with a more measured buyback, but critically LVMH puts a date on it, which is, I think, somewhat unusual, particularly for Americans looking at share buybacks. Can there be winners out of this?
Yeah, I mean, obviously the energy sector has been a massive winner over the prior 12 to 18 months. And just given all the issues around ESG and fossil fuels, it's no surprise necessarily that they would return some of that, if not a lot of that, to shareholders, because maybe the investment opportunities aren't as abundant. Everybody's going to be at a different place on that spectrum. And of course, you will see winners and losers always in the equity market. The bond market is much less, diversified in terms of day-to-day performance. Equities, even when there's a broad trend in one direction or another, there are individual names or sectors that are bucking that trend for specific reasons. If you're selling non-discretionary items, you expect to do better than if you're selling highly discretionary items. If you're selling items to the rich that tend to be very less sensitive to the cycle, to changes in income, you probably find that you're a much more defensive play relative to those highly cyclical sort of retailers. Of course, it's all horses for courses.
James, for a while, there's been a real bearish tilt to some of your commentary, and I've been sympathizing with it. And I'm wondering how painful it's been to be a bear through the ups and downs of this tennis match, as you put it.
Yeah, it's not been easy. It really hasn't been easy because actually it's not just about, getting fundamentals wrong. But, I've been surprised at the strength of the US labor market, and I've certainly been wrong in that respect, certainly in terms of timing, if not yet the end game, we don't know. But actually, there have been periods in this market over the last 2 years where I feel I've called the macro correctly, and the market has responded in a way which is just non-normal. I think the UK is a prime example. You had that dovish MPC just before Liz Truss's budget. To all the world, you think if a central bank is too dovish when there's high inflation, you should get a bear steepening of the yield curve. And instead, the market was just disbelieving of the central bank and bear flattened the curve. And those kind of moves have been painful. That's the job. That's what you sign up to. It's about trying to be humble. It's about, being disciplined. It's about, taking market signals, but not allowing yourself to be led by the market. It's a tricky balancing act, that fine line between humility and confidence, overconfidence. You have to find a balance. But it's been a very difficult couple of years.
So the difficulty in calling the macro, the difficulty in calling the market response to the macro, I mean, at a certain point, how much has the process changed? Has it become a dartboard, essentially?
I really think the process has changed. I think it's more evident in equity markets than it is in bond markets, but I think it's true of bond markets as well. And realistically, I think you can just summarize that as being there are less and less fundamental investors. So increasingly, the marginal buyer or the marginal seller is not somebody who's looking at the same data and information as you, who's not trying to form a view in the same way you are. They have very different investment styles and strategies, and there are very different triggers for their portfolio changes, shall we say. And its data is hard to come by. Certainly in the bond market, you're largely talking about over-the-counter cash trading, and over-the-counter derivatives as a big part of that. And so it's more difficult to get data. But it has, I think, meant that we overshoot relative to fundamentals more frequently and by a greater amount. And in markets as volatile as this, that can be really large gaps between market pricing and what I would consider to be the fundamental outlook.
This is all interesting, James. I'm really, really loving it, but this is not why we're having you on. John, help me out here. I got an email yesterday.
You want me to help you? What's happening?
I got an email yesterday that said more soccer, less Formula One.
Oh, they don't like the F1 shit.
They want the football talk. So we're going to do that right now with Athey because he is qualified. I'm lost on how many leagues these teams. This is not America. In America, you play Major League Baseball. That's all you do. Now, you got the Premier League, you got this league, you got that. The Tots visit Sheffield United, which I think is like Def Leppard, Joe Elliott, Flea is in there.
That's the FA Cup, yeah.
Would you explain to me why the Tots are visiting Sheffield United? I just don't get it.
That's the FA Cup. You play people in different leagues.
In different lower leagues, like minor league soccer.
Yeah, for a trophy at the end of that
Is like Britain,
winner takes all.
Is James Athey riveted by this?
No. James Athey just wants a top 4 finish to play Champions League football. But he'd love to see Tottenham win a tronty because Tottenham haven't won a trophy.
They haven't won a trophy since
so
long. Isn't there like a clock in Piccadilly Circus or whatever?
So
There's a Tots
basically
clock.
Count it up. James, before I let you go, I wanted to come back to something you said. I can't think of anything more frustrating than getting the macro call right and the market call wrong. I'm sure you know the work of Annie Duke, the former poker player, who wrote that fantastic book, Thinking in Bets. I mentioned it on the programme because I was rereading it last week. She often would say, don't focus on the outcome, focus on the process. Now, James, when you have a year like you've had where you nailed the macro but got the market call wrong, particularly in equities with tech leading and all of that good stuff or bad stuff, James, how do you reflect on the year so far?
Yeah, and that's exactly right. So yeah, I've read the same book. I love poker watching and playing, and Annie Duke calls it resulting, and I think it's really important lesson. Don't just judge the quality of the decisions on the outcome, but judge them on the process that led to them. And so in that case, I don't beat myself up too much. It's frustrating from a performance perspective at times, but it shouldn't lead to you to trying to do different things next time. You concentrate on where you really have got the macro wrong. The ECB, that's one where I was way too dovish with respect to the ECB outlook. I really underestimated how hawkish they would be prepared to be, and indeed how stable the bond market would be. So that leads to a bit more introspection about, how I've handled incoming information and sort of how stuck in a prior view I may have been. But the case of the UK is frustrating, but it shouldn't lead to too much change to process going forward. You continue to use your analysis and play the odds as you see them.
James, appreciate it, as always. James Athey there of Aberdeen. More still to come. Equity futures positive this morning. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. U.S. businesses are set to invest billions of dollars in Northern Ireland. But that's only if the deal on post-Brexit trading regulations leads to political stability in the region. British Prime Minister Rishi Sunak could use the prospect of international investment to help convince Northern Ireland unionists to back the deal. In northeastern Greece, at least 36 people have been killed in a train crash. 85 others have been injured. Authorities say a passenger train collided with a freight train just before midnight, starting a fire. The passenger train was traveling between two popular tourist destinations, Athens and Thessaloniki. Now, the Biden administration is preparing a policy shift that would encourage service stations to sell higher ethanol gasoline and offer it all year. The change is demanded by governors of corn-producing Midwestern states. It's unclear how the change would affect the prices drivers pay at the pump. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The moves that you would get if you followed a Bullard type approach is much more consistent perhaps with Fed history, that you could see the rates move a little bit higher to peak, maybe even towards a peak of 6%. But then once you reach that, you would break the economy. You would have to see rate cuts follow quite quickly.
David Page there, the head of macro research at AXA Investment Managers. On that theme, I think that you can maybe go back about 6 months, take that quote, take out 6, put in 4, and say exactly the same thing. We'll get to 4 and things could break. We'll get to 5 and things could break. And now we're saying we'll get to 6 and things could break.
Dead on. And in the history of this, to the 70s and the 60s, the last time we did this, granted this is highly unusual, is everyone adapts. Now, the housing market, witness what you mentioned earlier in the publication by the Dallas Fed that's making the rounds last night. Thank you, Dallas Fed, for sending me that. Is, oops, what if housing gets in the way? So that's maybe a little different, but you're absolutely dead on that we've had this conversation before.
If you're on a 30-year fix, 3%, lucky you, you're not feeling this. You're not feeling that at all. Why would you be feeling this?
Sit up.
You're just going to sit it out. You're not going to sell.
I mean you get some fungibility, like with divorces, kids move schools, whatever, the usual soap opera. But, you're right. A lot of people will sit this out. And that's why price won't not come down as much, and certainly in certain geographies as well.
Torsten Slok of Apollo put out this statistic that I thought was interesting. The interest rate sensitive components of GDP is only about 20% of the GDP. So yes, that is significant, but it will take time to bring down growth, especially when those interest rate sensitive areas have less interest rate sensitivity because of the 30-year time horizon, because of extending some of the duration.
Don't tell Joe Biden. The politicians will be more attuned to the interest rate sensitivity.
Do you think they are? I mean, given where the economy is, 3.4% unemployment.
As we get to the election 4 years from now, yes, there'll be more.
Sure.
After Labor Day, the election clicks in after Labor Day, as it does. It's an absolutely odd time. Is that a good time to talk to Damien?
I think that's the perfect time.
It's a perfect time to talk
great
to
lead.
Damien.
Thank you for that.
We'll do that right now. Damien Sassauer joins us here on EM, and I'm gonna just suggest in your world, not for all, but for some, there's a great unraveling going on.
Absolutely.
Rates are coming up, and it's Patrick Gillespie just in Buenos Aires really helped me on the unraveling. We know Argentina's terrible. Who are the other Argentinas?
Oh, the other Argentinas. Well, we know who they are. They're Tunisia, El Salvador, Ecuador. The list goes on and on. But you make a great point just about what we've seen in the last month alone since that payroll data, right? I mean, we've seen EM follow the Fed. Mm-hmm. Basically, EM swap rates, 2-year swap rates, it's the 2-year that really matters in fixed income these days, have absolutely blown up. I mean, we're talking 50, 60, in the case of Mexico, 100 basis point move in just 4 weeks. That is a massive, massive move.
As you measure this day to day, I mean, you slide in here at 7:30, 7:45 a.m. You start to check your Bloomberg about 8:30 after
That's late for me.
Cup of coffee. When you slide in, is there efficacy in looking at the credit default swaps of EM, or do you look at other Damien Sassauer secrets?
No, the synthetic market. I like the synthetic markets because they always overshoot, right? I mean, so CDS spreads in emerging markets have been following China, and we have to talk about China before our conversation's done here. But really, at the end of the day, sovereign credit default swap spreads across the whole of EM have compressed quite considerably, and that's what's taken the probability of default for those frontier economies like Argentina down so considerably this year, right? But you can't believe the CDS implied probability of default because it's synthetic. And it always overshoots. And I lost my microphone because my earlobe is too big.
I wasn't saying anything important.
But look, I think we really do have to talk about China. If I can't pivot, is that an okay pivot? Because, the PMI data,
I don't think, usually people just answer their own questions, don't they?
That's how this works.
Or they ignore me and switch to China. That's good.
Jonathan, Lisa, is anyone surprised by the PMI data that we've just seen overnight?
Shouldn't be.
No one should be, right? I mean, 5.5%, forget about it. Let's go for 6-7% GDP growth in FY23. But underneath the surface, and that's what we like to do at BI, that's what I like to do, let's look at inventory builds, energy inventories, LNG and coal, which are the feedstock for the Chinese economy. Inventories at ports and utilities in China are rising. They're at the highest since 2021.
Wait, hold on a second. Are you basically saying that you think that this data is inaccurate and massaged?
I'm saying there's a time element to everything we're looking at. Of course, people are excited about the China reopening. Of course, we expected a bang-out number here. But how are they going to be able to sustain that type of sentiment, right? So what I'm saying is, let's look at the underlying data. Let's look at travel. Travel's bounced back. Obviously, that's why the non-manufacturing PMI number was blow up at 56. Look at metals inventories. Look at copper. Look at aluminium. It came in 60 days into the Lunar New Year at 1.5 times 2019 numbers. It's come all the way down. So the end demand for wire rod, which is the first use of copper, or for OEMs demanding aluminium for whatever it is, their finished goods. Finished good inventories are rising. this is not good. I just don't see sustainable domestic demand.
I love that John Ferro comes to the U.S. and calls it aluminum, and Damian, you call it aluminium here in New York. I just want to point that out. I do want to just follow on. There's a question.
And in Aberdeen, they call it.
There's a question about how this translates into an emerging markets call that has been bolstered dramatically by this idea that China would be reopening and provide a boost to many of the developed nations that depend on it. Do you basically say that this isn't enough to give you that conviction to pile onto that trade, that if anything, on the peripheries, there's evidence to go against it?
Yeah, well, absolutely. I think if you look at the prices, I mean, look at thermal coal prices. They've come all the way down. They're reflecting this. What I'm saying is it's not going to be that. I think it's underperforming expectations. People thought China's reopening was going to be gangbusters for everyone across the board, and that's what this PMI data is telling you. But to sustain that over the course of the year is going to be near impossible. And I think what we're really playing for is another retreat, right? It's going to be a slow grind. And then in the end of the year, when the property sector may finally catch a breath. And look, we had some good housing data out of China overnight also. I think it rose for the first time in 20 months. But we're a long way away from normalcy there. So I think we need to see the property sector come back online. We've got some time, quarters. But that kind of takes me into my thesis, which is effectively there is a more durable play in China growth and the reopening than there is perhaps in the Eurozone and disinflation.
Okay, so final question here. If you took a 12-month rolling view of the economy in China, right now we're thinking 6, maybe. When you get to June, July and start looking out 12 months, are we thinking about 3?
Looking at 12, well, if you look at the IMF data, certainly if you look at the 2024, they're talking for 4% GDP growth. So yes, over the long term, structurally, if she can't get these reforms pushed through, if they can't get consumer spending, household spending, confident that they're going to have savings, right? If they can't correct the problem with SOEs where, local governments, where all of their public savings comes from, where, all their social services comes from, if he can't structurally reform that, we are not going to see the snapback to 5.5%, 6% over the long term.
That raises the question then whether we've already seen the reopening trade and maybe it started in October.
Exactly.
And now it's already over.
That's basically the suggestion, and that's basically what Damian's saying, right? Because the actual anecdotal data already points to the slowdown, the lack of activity that's going to come down the pike.
You got in at 5 a.m. this morning. I'm just going to say that. I see him every morning. I know what time it is.
I ran 3 miles this morning.
5 a.m.
I did. I ran 3 miles this morning. I got up so early. I was so excited to listen to you guys at 6 a.m.
You sound like Mark Wahlberg. What time do you wake up?
I can't sleep. I'm all jet lagged. I was in Miami last week.
That's the same time zone.
Yeah, I know, but I'm trying to just wanted to say I was in Miami last week. Is that okay?
That's so cool.
I love it.
It's real, by the way. I know you guys were questioning whether Miami's real or not. Miami's real. The orange
What are those socks? What are those socks?
University of Miami.
Oh, nice.
Well, bring
Represent.
them up here again.
Very cool.
I mean, this is too much.
What is happening here?
You see this?
I like that.
Collegiate socks.
Wait, where does your son go?
My son doesn't go to college yet. He's a senior in high school, but he will be going to the University of Miami.
There you go.
There we go.
Carry on.
That's nice. This was nice. Wasn't that a nice segment?
On radio, it was emotional.
Selling socks.
Selling
University
socks.
of Miami.
Aluminum, aluminium, cross-border love.
If I say aluminum, I get so much from back
it's
home
like
in the
Maryland.
UK.
Stop it,
I say
John. Just say aluminium.
And then, people say, you've been living here 8 years.
Can I just say the most important...
passionate about this stuff.
Go aluminum.
Yeah.
Most important date going forward, guys, if the music's not playing yet, March 15th, Ted Lasso.
We can play the music if you
Ted
want.
Lasso.
You can play the music whenever
By
you
the way,
like.
is Jamie Tart, is that Jack Grealish? Is that supposed to be Jamie Tart?
It's a little bit
it is,
like
right?
It's a little bit like
I think
him.
it is, right?
It's a little bit like him.
Yeah. I love it.
Are
I
you
can't
watching
wait.
Formula One? I mean, you're the one last.
I'm already 5. I'm in the final season. I'm already 4 or 5 episodes in. I think.
Yeah. Okay.
I love F1.
And the Netflix
it's the best.
thing.
It's changed my life.
You're gonna watch this
and
weekend?
the golf one. I forget the name of it. I just started that. I'm in the first episode.
Okay, well,
that's beautiful.
Wait, it changed your life. How did it change your life?
Mode push. Look. I mean, look. The way I see it is, it's about performance of the engine, right? You need a bigger engine. You need, you need a better machine. It's all about perforance. I try to stay efficient. I try to stay lean.
Yeah.
Try to perform every morning.
Love it.
So you're on with your team with Bloomberg Intelligence, and those poor young kids are there, and you're going, "That's good. Push it." Push.
Mode push. DRS.
I love F1.
Does Rich Truman whisper that in your ear?
He does so all the time. Yeah, I asked him, Fernando's destined.
I love Fernando.
Well,
it's too bad they never got him that win, man.
My advisor
it's too bad.
I blame
Scuderia.
I blame Ferrari.
Yeah. Don't spoil it for him. He's not all the way through yet.
Look, the idea that you're watching championships that took place years ago. Look, if it encourages interest in the sport, fantastic.
All
right.
Diplomacy.
The new season begins this weekend.
I think the economy is surprisingly strong.
If you look at where valuations are, it's pricing in still a very modest kind of growth outlook for the economy.
Markets are adjusting to the fact that the Fed has more work to do.
We may see some gentle drift back down in rates, but the people that stay in cash are not going to lock in the returns for the long term.
Our view is still that we do see a mild recession. I stress mild.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. A most interesting day. Important March 1st data here at 10 o'clock. John Ferro's focused on that. ISM, John, Lisa showed the chart earlier, and I'm sorry, the vector is weak on the general ISM statistic.
That's on manufacturing, sub 50. Yeah. Let's see if it surprises to the upside and continues the progress we made at the start of the year for the month of January. January, really robust economic data in America. Will February confirm? Get a sneak peek of that a little bit later with the ISM manufacturing. A little bit later this morning, I believe 10 a.m. Eastern time. The here and now, another upside surprise for Eurozone inflation. First, it was Spanish inflation. It was French inflation. Now it's German CPI. 9.3%. The estimate was 9. The previous read was 9.2. TK is going in the wrong direction. Euro dollar is out 1 full percentage point this morning and approaching 107. And there's talk all over the place about that ECB going 50 basis points this month and maybe in the next meeting as well, and perhaps even a consideration of needing to do a whole lot more after that.
It redounds over to the United States as well. I've got now the 210 spread out to negative 90. It was negative 89 before that German statistic. And what's important to me, John, is to be clear here, folks. This is not a disinflation study. Many of these series, John, are up. They're inflation realities.
Without a doubt. So now you've got Germany, you've got Spain, you've got France. We'll get a read on Italy. You get the Eurozone composite, the aggregate of it all, a little bit later this week. And we're going to be talking 4% interest rates of the ECB, Lisa. Now, that's a major change from where we were 6 months ago. So the conversation around the Fed now is 5.50 to 6. The conversation around the ECB is something close to 4.
And the conversation from an economics perspective is, what don't we understand about the nature of this inflation? Because the narrative has changed around this is an oil shock. This is a different type of inflation than what we saw in the U.S., too. This is a broad-based inflationary push that has stemmed from wages, that has stemmed from services, that has stemmed from tourism, and is going to be really tough to beat. What is the consequence going to be of raising rates to 4%?
I'm going to suggest this is foreign for me and Lisa. It is not for John. This is the cultural fabric of Europe, John. These statistics, whether it's 7% France, 8%, a stunning 9.3% statistic on harmonized inflation, culturally, that is unacceptable for core Europe.
And that's why they've got to go 50.
It's like visceral.
And I would imagine, based on this data, going into the next ECB meeting, there's going to be a push from the Hawks to confirm the next move is 50 as well. So the current guidance is 50 for the March meeting. The Hawks are going to want a commitment to go 50 again, just to try and retain some credibility around the inflation target.
Do the Hawks get hawkier, or do they bring neutrality? I mean, the Netherlands and Germany will be there. I get it. But do the Finlands, do they come along with them, or do they fight tooth and nail?
I think they are going to come along with them, because what choice do they have? What's the argument right now, looking across the Eurozone? Now, I mentioned this a little bit earlier. This is pretty simple. It's not just Germany. It's Italy too. It's not just France. It's Spain as well. And that's the problem that we have at the moment, Tom. It's right across the Eurozone. I'm not sure what the argument would be up until, and I think you'll hear more from the likes of Meloni out of Italy, the leader over there, up until you get a severe break in the bond market in places like Italy.
Or until you have to actually use said bond market to finance any fiscal kind of stimulus or fiscal support that might be needed in the wake of any weakness. Because all of a sudden then you start to talk about coupon payments that become a very different proposition.
Such a good guest here. Let's get on to the data check to get to Michael Schumacher. And John, I'm just going to suggest here 210 spread at negative 90 and the 10-year U.S. yield 3.93%. Any more data like this and they move.
Yeah, yields up in Germany. Yields up in the United States, particularly over the last month, some big moves. We're higher by about a basis point on a 10-year stateside, 393 on a 10-year yield. In the FX market, there's the move on euro dollar.
Look at the euro dollar.
106.84. Bit of euro strength, some dollar weakness out there. particularly dollar weakness, Tom, at the moment in G10.
Yeah, and it's a collared as well. I mean, if 110 is it's a round number on the collar, can we imagine the euro breaking out off higher interest, higher inflation to something above a 110? I don't think that's in.
We had 110.33 on the day of the ECB meeting. I think it was February 2nd. We had 110.33 on euro dollar. Just came all the way back in after that blowout payrolls report.
Let's get to this right now, and it's perfect time. He's been digesting this German data. Global head of macro strategy at Wells Fargo, Michael Schumacher, joins us this morning. Mike, forget about transitory, but are we moving away from disinflation to actual price stability or outright inflation?
Very sticky inflation, Tom, and I think that's really the challenge. I think the point about Germany and core Europe reacting viscerally to inflation is excellent. Talking to clients over many, many years, that's always been the big fear in Germany for obvious historical reasons. So this just doesn't work. It doesn't fly. Whether it's sticky, whether it's accelerating, it's just simply too high.
Mike, when you look at what's taking place in the bond market off the back of this, it's been orderly so far in places like Italy. And Mike, Lisa, Tom and myself, we all talked about this just moments ago. If you told us that this ECB was going to go to 4, I think we would all have said, the Italian bond market's not going to survive that, Mike. We're going to have real trouble. Mike, have you been surprised by the stability on the periphery? And are we getting to a point in your mind where things could become a little bit more troublesome?
It has been surprising, John, and I think the comments about fragmentation, about the periphery, we haven't heard much about them in the last month or two. And I think now it's because the ECB has the main challenge right in front of it. It simply has to get inflation down. It's going to have to tolerate some volatility in peripheral spreads. It's a little bit surprising it hasn't come up previously, but I think that's why it's not.
There is a larger issue, though, Mike. We were talking for years about how we couldn't really exit this zero rate regime, this negative rate regime, without more ripples, without more consequences in financial markets. Now we're talking about a 4, 5, 6% regime, depending on which nation you look at. And we're not seeing the ripples in terms of difficulty in borrowing, questions around the validity of stock valuations in any kind of existential level. Mike, what's going to cause this to change at a time when people seem to be just resetting their understandings of the interest rate sensitivity of this global economy?
I think it's going to happen, Lisa, there's a couple of things. Number one is governments are going to have some difficulty over time, but not yet. And secondly, when you think about corporate borrowers, there's a bit of a lag function. Probably takes a couple of quarters for corporate default rates to go up meaningfully, but it's very likely going to happen here in the U.S. You're probably looking at something like a 7% default rate, for instance, in high yield this year. That's material, but it takes a while to get through the system.
We've been talking about how difficult it is to really game out the macro data and then to understand what the market's reaction would be to said macro data. When you take a look at inflation coming in hotter than expected on consecutive days, France, Spain, and now Germany, what do you do with that information? How much does that shift your view or your trades that you're recommending?
Yeah, for us, one thing that we've been looking at quite a bit, as you can imagine, is relative pricing for the various central banks. So, for instance, ECB versus Fed. And usually we'd fade the ECB, and right now you just can't do it. So I've been more in the camp the ECB would not deliver, but after seeing this parade of very nasty inflation prints, I think you've got to lean towards the ECB going 50 this month is virtually a lock, and 50 next month looks more and more likely. So very tough to fade the ECB, very tough to fade the euro right now.
Let's take that further. Do you think there's more chance the ECB gets to 4 than the Fed getting to 6?
Tough call. I'd give the Fed the edge there, John. So if you look at market pricing now, it's called a 20% probability. Looking at options pricing, the Fed is at 6 at the end of the year, so a little bit higher than that in terms of terminal rate. I'd lean slightly toward the Fed, but it's a tough call right now.
Wow. The fact that that's even a tough call, just that conversation, the fact we're not even sitting here saying like 4 is ridiculous, 6 is nuts, but we're actually taking that seriously just tells you where we are. Mike Schumacher of Wells Fargo. Thank you, Mike, as always, sir. TK, just unreal stuff.
This is great, and if Schumacher with his just hugely holistic view is fabulous. And I go back, and I'm still not over the untimely and far too early death of Martin Feldstein of Harvard. He was a massive Eurosceptic. I mean, if not the American Eurosceptic. And there he was, and this is well over 10 years ago, writing that, I'm sorry, history is here, and history cannot be reversed. But Martin Feldstein, And Barry Eichengreen and the rest in America looking from a distance at this experiment, which was, John, you lived pre-Brexit and you led our coverage on Brexit. The bottom line is none of this dealt with 7% inflation. Ottmar Issing is the arch-German conservative. Over to Martin Feldstein, dead set against the experience. None of them framed 7% inflation.
Go back to the hikes of 2008, 2011 from Trichet at the ECB.
Yeah.
And go through the statements. And when you go through the statements and they're talking about the risk around the inflation outlook and price stability, close to but below 2%, and you look at where inflation actually was, that was the concern at the Trichet ECB of inflation levels in and around 2% at least. So that just frames this conversation in Europe at the moment. 9 is a massive problem. When I look at the comparison between now and the years of 2011, 2012, Germany was stronger than the periphery. Germany had a stronger argument to say, we don't want all this easing. I get all that stuff. But when you look at Europe now, Germany's arguably been the problem child of the last 12 months. And they've all got the same issue to face, which is inflation is too high, which makes this decision for this ECB just a whole lot easier. They've got to keep going.
The most unnerving part about this is we don't understand the inflation picture, perhaps not even why it was so low before in the decades where it was an ambition to get to 2%, all the way up to 2%. Now, there's a sense that we keep underestimating the stickiness, and we don't understand why. People will come up with theories, but they keep changing them every day.
That phrase, we don't understand, that's the one we keep needed to say, because so many people don't have a clue what's going on.
So are the balance of risks now that inflation is going to get hotter and hotter? And I think that really is the key, that for central banks, the balance of risks has not yet shifted to the concern about destroying the economy. The balance of risks is still sorely on defeating inflation, and that is the priority.
I'm conscious this story, though, has changed like 4 times.
It switches every day, yes.
In 2 very quick months.
Yes, correct.
Just go back to those meetings, back to back. Federal Reserve, disinflationary process has started. Lagarde 24 hours later.
It's over.
The risks around inflation are becoming more balanced. Not balanced, but more balanced. Like, come on. Here we are a month later, going into these meetings this month. Just a completely different conversation.
Disinflation died.
And it could change in 2 Fridays again. You know,
and
get a big revision to the previous month on
Exactly.
payrolls. It was like, yeah, I told you so. It was a head fake. Futures up a 1/10 of 1% on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Bank of England Governor Andrew Bailey is signaling that further interest rate increases may be needed to contain inflation. In a statement, Bailey said that doing too little now may mean sharper rate hikes later. He said the experience of the 1970s taught that lesson. In China, the economy is showing signs of a stronger rebound after COVID restrictions were abandoned. Manufacturing posted its biggest improvement in more than a decade last month. Meanwhile, services activity climbed and the housing market stabilized. FBI Director Christopher Wray says the agency previously determined that the COVID virus most likely originated from a potential lab incident in Wuhan, China. Wray's comments to Fox News contradict scientific claims that the virus emerged naturally. He said the Chinese government has been trying to counter the work the U.S. is doing in that matter. Lori Lightfoot has become the first mayor of Chicago in 40 years to lose a bid for re-election. She finished third in Tuesday's election. An April 4th runoff will pit former Chicago Schools Chief Paul Vallis against Cook County Commissioner Brandon Johnson. Lightfoot was unable to overcome voter dissatisfaction with Chicago's rising crime and slow economic recovery. And it's the latest outage for Twitter since Elon Musk took over the company and fired thousands of workers. Users reported there were problems loading the service today. That follows problems last month that prevented users in the U.S. and Asia from tweeting, checking messages, or following new accounts. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
There were some clear successes, but there were also some clear stumbles. On the direct consumer businesses, we found them more challenging. It became clear that we lacked certain competitive advantage and that we did too much too quickly, which affected our execution.
David Sullivan there of Goldman Sachs measured the chairman and CEO
Looks like
facing
he's
a bit of
rolling out a
pressure.
new iPhone.
At Investor Day. Is that what that looked like?
It's like, hold on.
Steve Jobs throwback.
We are
Apple.
so far away from what it used to be.
Is that where Goldman's going?
I don't don't know. It looked like, for those of you on
next.
radio, he's got the big screen up in front and he doesn't have a tie on and he's, we got a new chip and a new
They're going to love
camera.
your coverage. They really are. The new iPhone with Goldman Sachs. Equity futures right now up 0.1% on the S&P. Yields a touch higher by a basis point. German inflation out moments ago. German inflation coming in hot and widely anticipated after the regional breakdown from state to state across Germany we had earlier this morning. CPI comes in at 9.3%. That's up from 9.2 month over month. Just to get the month over month number, 1% is not good. Year over year with a 9 handle, month over month at 1. That's going to mean one thing for the ECB. We're going to hike rates.
We got to cover this right now. It's just too important. They have to stagger to March 16th. Do they jawbone like poor Lisa has to talk about Fed officials? Is there jawboning pre-March 16th?
I think it's tough to say. The current guidance is 50 at March 16th. That's kind of done. So they're going to go March 16th, 50 basis points.
But does everybody speak?
At the Governing Council?
Yeah.
Yeah, sure, of course.
Okay.
They'll get around the table at the Governing Council, and the big conversation is going to be about whether they communicate going another 50 at the next meeting and commit to that.
Yeah. Does Neil Kashkari weigh in?
Kashkari, can I give Kashkari a shout out?
Please.
Came out earlier this year in a blog post, and everyone always throws mud at Kashkari. I get it. He's gone from like Uber Dove to Uber Hawk. I understand all that. He said 540. I need to get to that's where I want to be, 540, and then I want to stay there. Forget this rate cut stuff. What did we start pricing in the last week? 540, and started pushing out rate cuts.
And his tone has been correct. We need to see evidence of the disinflation that people believe in, and we're not necessarily seeing sufficient evidence yet. So he's been right in terms of that narrative as well.
We're to my break to go. The narrative at Goldman Sachs that we saw yesterday. Thanks to Shonali Basak for her wonderful coverage. Now we speak with JM Securities. Devin Ryan, with years of following the travails of Wall Street. Devin, I know you memorized all 118 pages. You know what I did. I went to the money chart. It's on page 68. Enterprise partnerships, disciplined growth. And the hope and a prayer out 2 years is on the consumer area. The net revenue goes up and the change in net reserves comes down. The hope and a prayer is a 2-year path to a better consumer bank. Were you sold on that? Were you convinced yesterday?
Hey, good morning, Tom. It's a road here that is going to be a little bit complicated on consumer, but I think you have to give them some credit. They had their first investor day 3 years ago. They hit all their targets they laid out there. At least in terms of ROE and efficiency ratios. And the key drivers, I know we're talking about consumer here, but the key drivers are what they're doing in the investment bank and asset management. And consumer is one piece. It looks like they're going to look at some strategic alternatives there and maybe even look to sell some of those assets. But yeah, we think they're going to hit their targets as they did over the last 3 years. So I feel pretty good about that.
Is there an Eaton Vance out there to buy? How do they jumpstart this a la Fortress Gorman?
Yeah, they've been doing some small tuck-in asset manager acquisitions. Really, the big focus in asset management is in alternatives, and they've already raised pushing $200 billion over the last few years. Here, they're going to raise another $50 billion or so over the next 2, and so they're seeing 13% revenue growth CAGR on their asset management fees, and I think that's going to continue here. So they made a really credible pitch there. I don't think they need to do inorganic things, but I think they're going to look opportunistically. That is an area where I think they could look to do some M&A.
Devin, at times he was described as getting flustered. You were there. How would you describe his performance?
Yeah, I think, well, first off, the stock's up 110% since the beginning of 2019. He took over in 2018. So they've 2x the S&P. So I think you got to give them a little bit of a pass here, and they've hit their targets over the last 3 years. I think he's frustrated with some of the narrative in the market, and I think the company's sharing more than they've ever given before, and they're not hitting everything. And I think they're clear that there's been some missteps here, and I think it's frustrating the pushback that they're getting. But he did mention that their partner headcount, the turnover there is at a low since 2014, and their employee turnover is at a 5-year low. So they're not seeing a mass exodus in any way. And again, their book value's grown almost 40% since their last investor day, and the stock has outperformed the S&P by more than 2x since that day. So I think they deserve a little bit of a pass here, and I do think they're executing, just not hitting on all cylinders.
Do you think the problem is that they're not Morgan Stanley and he's not James Gorman?
Yeah, well, listen, I mean, Morgan Stanley, there was only one Smith Barney. Morgan Stanley did that deal, and that's been kind of a transformational opportunity for them, and they've made some good decisions. And so, yeah, Morgan Stanley has outperformed in some areas. I think, Goldman Sachs is saying, listen, we've outperformed in a lot of other areas. And so, I think it's a slightly different business mix. And the last few years, the business mix has definitely been towards Morgan Stanley's favor. But Goldman Sachs, they had a phenomenal outperformance in 2021, did better than anyone else in the industry. 2022, we're talking about the most recent year. 2022 was a really tough and I would argue abnormally difficult backdrop. And we get some mean reversion. I think Goldman Sachs will be right back in the running, and people will probably stop giving David Solomon a hard time.
There have been a lot of discussions about repairing some of the mistakes that Goldman Sachs is perceived to have been made. And this is really focusing on the consumer banking unit. There was a discussion yesterday about finding strategic alternatives for a number of different units, including Green Sky, the specialty lender, as well as the credit card partnerships with Apple and others. Do you think that this is a good move on their part? Do you think that trying to offload big parts of that consumer credit business is the way to go?
I think that based on the new directive in consumer, which is to be more profitable and more targeted, it makes sense. Obviously, you have to have the right buyer and right transaction if that's what they're going to do. But I think Goldman in their ethos came up yesterday. But when they have a bad trade, they normally don't sit on it. And I think this is a situation where, they get a little bit of mud by making a mistake in this one area, but they need to move on and get themselves in the best position. Again, this is a small part of the story in our thesis, but I do think that potentially looking to exit some of those businesses could make sense at the right price. And it will just kind of take away also some of this, I think, overhang that's getting more attention than probably deserves, but that they would like.
That's the theme of this conversation, Devin, that maybe they are getting too much criticism than perhaps they deserve. As you look across the coverage of this name, the stock that you cover, both in the media and from the analyst community, from your peers as well, do you ever get the sense that this is personal? It's actually just about him, the individual?
I don't know that it's personal. I think it's, Goldman Sachs for, really its history has delivered, I think, outstanding performance. And so I think it's just kind of human nature that when, firms are really performing well, people want to, find areas to knock them down. And, Goldman, before David Solomon came in, was really a black box. And the last 3-4 years, they've given a lot of transparency, and they've given a really detailed roadmap on their expectations and how they're going to get to their targets. And so when you do that, you're always going to find things to critique. And this consumer area is one thing that they haven't really delivered on, but also the market mentality shifted. People don't want to subsidize anything losing money, whether it's a Goldman or a tech company or fintech. And so I think that's really more the mood. And so I don't think it's just David. I think it's more of a Goldman's done well. People want to nitpick here.
Devin, thanks for that. Devin Ryan there.
Devin, thank you.
Of JMP Securities on the latest with Goldman and their Investor Day. Here's the latest for you, Tom. You asked me at the Governing Council at the ECB, do they all talk? Maria Tadeo. No, the Latvians just sit there quiet and the food is distributed based on GDP.
That's amazing.
Maria. That's Maria's insight to the Governing Council. I'm pretty sure that's a joke, just so you know. Coming up in the next hour on Bloomberg TV, here's your lineup. Mike Wilson and Morgan Stanley. Do not miss that. 9:30 Eastern Time around the opening bell. We'll catch up with Stuart Kaiser of Citi, Subhadra Rajappa of SocGen to break down this bond market move as well. Awesome lineup.
Great, it's good equity lineup there as well. Can I defend Mr. Solomon? Banking, 31 billion revenues. Wealth management, 17 billion revenues. Platform solutions, 2 billion revenues. It's tiny.
We've discussed that, yeah. Futures right now just rolling over, just about unchanged on the S&P 500, 60 minutes away from the opening bell.
Bloomberg Surveillance, Lisa Abramowicz and Tom Keene on a most interesting day. Mr. Ferro getting ready for a 9 a.m. hour. Mike Wilson to join John Ferro in that hour to explain the challenges of this equity market. Red and green on the screen again, in shock over German inflation. As you've heard Michael Schumacher and Damian Sassauer talk, it has been absolutely extraordinary. And well-timed, Bloomberg's Maria Tadeo speaking with the Bundesbank president, Joachim Nagel, after the release of the bank's annual report.
It seems to be the case that inflation is very stubborn. And that is bringing me to the point that monetary policy has to be more stubborn. It's not fair to speculate what is the sequencing beyond March, but it looks like for the moment that 50 basis points for the March meeting, very necessary.
And perhaps so important for all of our listeners and viewers worldwide, 9% inflation in Germany. Maria, today it sounds to me like just possibly we need a surveillance road trip to Germany to really understand this high inflation. With that conversation, what did you learn about what I'm going to call the sweat factor, the angst of 7, 8, and 9% inflation?
Yes, Tom. And to be honest, I think he himself framed it very well. He said 2023 is going to be, quote, a bumpy year for Germany and the euro area. Again, when you look at the numbers for this year, they expect inflation in Germany, this is just for Germany, between 6 to 7%. And he told me, as the head of the Bundesbank, that is not acceptable to me. We need to bring down inflation. I think the other concern that he pointed to is this changing dynamics potentially, where you see headline inflation go down, but core inflation stays sticky. And for the reputation of the central bank, that is even more problematic. In terms of what to expect from the European Central Bank, obviously, yes, Tom, everyone speaks at the Governing Council, but this is the biggest economy, so obviously he carries a lot of weight. He told me essentially March, 50 basis points, quote, that is very necessary, but then it's going to continue from that point, and it will have to continue. Now, he did not want to get into speculation, put a significant number, but I did ask him, the market, we've seen a big repricing yesterday, 4% rates. Would you feel comfortable with that narrative? And he told me to some extent, yes, I'm comfortable with that narrative. Not only that, but we also heard from him earlier this morning, Maria, that he would like to see a more rapid acceleration of quantitative tightening, of the reduction of the balance sheet of the ECB. How much company does he have on that front? Look, I think we're about to find out. And again, it goes back to the point that's actually a very fair point that Tom made. Who speaks when they gather, and how does it work? And essentially what you have is 20 economies which have very different dynamics. And now it's 20 because, remember, Croatia joined the euro this year. And you have to essentially bring everyone together around the table. I think this is a debate that he wants to put forward. He told me it does merit a conversation, but we're going to have to wait until the Governing Council meets in 2 weeks' time.
Maria, our American viewers and listeners need a primer right now, which you are encyclopedic on. I'm going to say it's Germany and the Netherlands are the arch hawks. Spain has 8% inflation. Has Spain joined them as arch hawks?
Look, that's such a very good point, Tom. And as you know, the governor of the Bank of Spain, who was the chief economist before, so we go a long way back with Hernández de Costa, that's in fact the governor of the Central Bank of Spain. I think at that point, you see that the cliches do not fit, because when you talk to him, he will tell you with that kind of inflation, the Central Bank of Spain cannot be a dove. It should not be perceived as that. When you look at his calls on fiscal policy, he also says there should be restraint this year. So it does show that perhaps in this new era of central banking, the old playbook does not work.
Maria, thank you so much, and congratulations on a timely interview with the head of the German Bundesbank. A wide-ranging conversation now with a little bit of red on the screen here. Futures at -4. Carl Weinberg joins. He's chief economist at High Frequency Economics. And Carl, you had such a stunning note, and it's off our radar. We have not mentioned Japan today. But for our American viewers and listeners, maybe not schooled in this, guys like you say Japan is really, really important. And the tension point is not yield curve control and their experiment out to 10 years. It's the debt out past 10 years, and that has deteriorated price down and dramatic yield up. What does that portend for Japan?
Hi, good morning, Tom. So the Bank of Japan has work to do. The end of the fiscal year is now just a few weeks away, March 31st, and there are substantial capital losses on what I'll call the ultra-long segment of the JGB market, the part where they haven't been trying to control the yield curve. So those yields are up about 70 basis points compared to where they were at the end of the last fiscal year. And that implies, between 30 and 60 trillion yen worth of capital losses, which are big enough to wipe out the balance sheets of a lot of the institutions. So the Bank of Japan and the Finance Ministry are going to be out there in size over the next few weeks, buying up this asset, encouraging to buy the asset. They're going to move the market lower. They'll do it, but it'll be quite a challenge for them.
How close are they, and I don't mean to an absolute owning the bond market, but on a trend line or a glide path to owning the bond market? Where is the Bank of Japan? Maybe use a baseball analogy. Are they in the third inning or the eighth inning of buying every bond that's issued in Japan?
Well, at the short end of the yield curve, out to 10 years, they own, I think the number is about 65 to 70% of the market. And then at the ultra long end, they own a lot less because their target has been to control yields from overnight out to 10 years. So they still have scope to buy at the ultra long end of the market. But yes, you're right. And Bank of Japan Governor Designate Ueda said this in testimony the other day. The BOJ can't buy bonds forever, and at some point this has to come to an end. When it does, there will be capital losses in the bond market, and yes, I think that will imply that will generate some institutional risk.
The odd monetary experiment of Japan aside, the rest of the world is grappling with deeply entrenched inflation, at least by all accounts, and what we saw this morning out of Europe with respect to Germany's 9.3% February CPI read year over year. Carl, you've ascribed this idea that we will see inflation roll over, perhaps prices stabilize at a higher rate. How do you hold to that conviction if we're just not seeing it in the data?
You know, let me frame my answer in terms of the interview that you just broadcast with Mr. Nagel. All right, I was so glad to see him talk about quantitative tightening. All right, the inflation-adjusted money supply in Europe is still 4.5% higher than it ought to be, given the current level of output and recent trends. So sure, there's too much money chasing too few goods, and that's pushing up prices. I view this as a price adjustment that will run its course when real money supply is deflated back to where it should be by a combination of quantitative tightening and by rising prices. So we still have more price increases to go. But there is an end in sight to this process. This is not the spiraling inflation that we saw in the 70s. I don't think interest rates matter nearly as much to the ECB and to the course of inflation in Europe as quantitative tightening does.
So aside from just understanding the quantitative tightening, which I do want to get into, since that is something that's being raised by the German central banker, how much are we looking at what you view as an overreaction by central banks to something that is perhaps stickier, but not inevitably protracted and spiraling?
Well, I think that they're chasing the wrong thing with higher interest rates, which is not to say that I don't think this rise in interest rates isn't a good thing in the longer run. We've had negative real interest rates in Europe since the financial crisis, and it's time to straighten that out so that investment doesn't get misallocated and so the economy can grow in a healthy way. That's a good outcome here. But as they move much beyond 200 basis points or 300 basis points above inflation expectations, it'll become restrictive, and they'll start to make recessions that are already going on even worse.
Carl, you and I could go for 2 hours this morning on your wonderful heritage of Latin America, which is falling apart, Argentine peso, but I really got to stay on Europe here. A lot of people publishing right now, including Commerce Bank and Melanie De Bono over at Pantheon. And Carl, the basic idea is, look, there's EU inflation. And I know our listeners and viewers are saying, do we import that? Do we bring their inflation at the margin over to give us a lesser disinflation?
Well, I mean, surely at the margin, you know, what happens in Europe does transmit to us through trade prices and other forms of arbitrage, but it's really quite at the margin. The price increases we're seeing in the United States are coming about, in my opinion, because we've got excessive cash balances in the United States also. Cash balances are over $2 trillion higher than where they ought to be, given trends in the growth of the economy. Right. And until that gets sorted out by a one-time rise in prices and or by quantitative tightening, we're still going to see prices going up here. That's the main event. That's the show, Tom.
Carl, thank you so much. Carl Weinberg, High Frequency Economics this morning. We've got to leave some time here. Just to sum this up, my head is spinning over the geographic reach we've done this morning. It's like we're around the world with economics, finance, and investment. That's is someone's. I think George Saravelis at Deutsche Bank. I'll give him credit for this. We're just at this critical 2 weeks.
Around the world with one story. which is more rapid growth and more rapid inflation than many people expected, then over to the central banks. What do you do with that, right? I mean, how do you basically navigate a world that, as Carl Weinberg was saying, perhaps is less interest rate sensitive, and a world that we don't recognize after years, decades of low interest rates and imported disinflation from globalization?
The fact is, in terms of history, it can be Anna Schwartz and Alan Meltzer and the rest. We're data dependent. We're ex post. Fine, we're there. We have 9% inflation in Germany, et cetera, et cetera. So it's the acting now. And as John mentioned, the ECB is going to pop 50 basis points here March 16th. We're here. The data dependency isn't out there. It's here.
And you're going to see a response to that with higher rates. If you take a look at what the market's pricing in, it's a 4% ECB rate. If you take a look at what the market's pricing in for the Federal Reserve, it's gotten up to 5.4% by July. We now have a peak rate of 5.43% by September. It's not going to go below a 5.3% before the end of the year. That is what the Fed funds market is now projecting as we game out what a higher for longer type of scenario looks like.
What is your bond space telling me? I looked at twos as compared to the former benchmark 30-year bond. We've never in the modern history had this inversion. How does that devolve over to high yield, to investment grade, and the rest?
You're right to point that out, and we're actually seeing new lows this morning, and these are sort of the greatest inversions, the greatest inversions, the greatest the differential there. What it means is we're going to see yields stay high at the long end until growth declines enough. You aren't seeing a feeling of deep recession really being baked into credit markets.
I can tell you in all the years of doing this, folks, it's real simple. You talk to me in Europe, a 7, 8, 9% inflation. That is, in the modern day, an original conversation. U.S. futures deteriorate, S&P futures at -6. The VIX 20.62. Stay with us. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. U.S. businesses are set to invest billions of dollars in Northern Ireland. But that's only if the deal on post-Brexit trading regulations leads to political stability in the region. British Prime Minister Rishi Sunak could use the prospect of international investment to help convince Northern Ireland unionists to back the deal. In the UK, the cost of living crisis showed little sign of easing last month. Prices in British stores rose in February at their highest rate since at least 2005. The British Retail Consortium said shop price inflation hit 8.4%. Food prices rose even faster, 14.5%. In northeastern Greece, at least 36 people have been killed in a train crash, 85 others injured. Authorities say a passenger train collided with a freight train just before midnight, starting a fire. The passenger train was traveling between two popular tourist destinations, Athens and Thessaloniki. Home purchase applications fell to the lowest level in nearly 3 decades last week as mortgage rates soar. Now, according to the Mortgage Bankers Association, a 30-year fixed home loan rose to 6.71%. That's the highest level since mid-November. And baseball legend Alex Rodriguez and his partner, Mark Lohr, want to take on Ticketmaster. They've raised a $30 million funding round for a new ticketing and fan experience business that they hope will outperform the industry's troubled incumbents. Their company is called Jump. Now, among the backers are Mastery Ventures and Drive by DraftKings. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Bloomberg Surveillance, 3, 2, 1. Take a breath. Lisa Abramowicz and Tom Keene with you on a really interesting day. I mean, it sets us up for Thursday tomorrow. And I got claims. I mean, do we just state? Well, of course they're going to be under 200,000.
Well,
but ISM at 10 o'clock is really the lead data point here.
Well, we get 10 o'clock today, 10 a.m. We get the manufacturing ISM, and then on Friday we get the services ISM. And how much do we get this ongoing strength on both sides? No jobless claims. This idea that you are not seeing a weakening. How much does that get confirmed And how much more do we have to price in, or if we priced in the response from central banks?
The cacophony it is. We thank you for joining us on radio, on television here. Just really, really eclectic conversations. I thought Carl Weinberg on Japan. I mean, how obscure is that? We go yield curve control out to 10 years. Oops, there's other debt out there somewhere.
Well, yeah, and this question with UATA saying we can't buy bonds forever. They can't own everything always going forward. And this is perhaps a departure from previous ideas.
We're going to try to calm down here. We can do that with Ira Jersey, always sensitive. He's chief U.S. interest rate strategist at Bloomberg Intelligence. And we can try to look forward in a measured way, which is what he publishes with, among his colleagues, Will Hoffman at Bloomberg Intelligence. Ira, I get a sense of real calmness in that when everything is said and done in the hysteria of European 7, 8, 9% inflation, you people are actually modeling out some form of a lower interest rate trajectory. Describe that trajectory.
Yeah, so it's basically a reasonably flat, kind of range-bound market, at least in the long end for now, and that's predicated on some of the things that you and Lisa were just talking about. Higher inflation in Europe, the possibility that yield curve control in Japan ending could, that's going to roil the U.S. and European sovereign debt markets, at least for a short period of time. So you have this risk that maybe we see a 4%, maybe a 4.25% 10-year yield, but then thereafter, when you see a lot of the other underlying data, eventually the economy is going to slow, and even though the glide path is much shallower than we thought for inflation is likely to be lower at the end of the year than it is today. So because of that, we do think that interest rates and long-term interest rates in particular will probably be lower later on. And today's data point, you guys talked about ISM coming out of 10. That ISM new orders in particular tends to be one of the best leading indicators for the path of the economy, and we're nearing, if not right at, recessionary type levels. So that's super important today.
Are you suggesting we need to have our radar up for a 4% 10-year yield?
Yeah, I am, primarily because we've been hovering here and kind of testing the waters as to whether or not we can breach that 4% area. And we've actually broken a pretty important technical level. So there's not a lot of technical support up to around 4.25%. So you wind up getting some decent data. It might be today, like, for example, if ISM new orders bounces and is above 45, for example, that could be an impetus for us to once again test 4% and maybe break up above. And of course, once that happens, one of these interesting dynamics starts to reemerge, probably, where risk assets falter a little bit, credit spreads wider, equities down, rates up a little bit, but then rates are going to have a harder and harder time probably moving higher when risk assets are doing so poorly.
When you say rates, perhaps that's on the long end. On the short end, though, there's a real question on what's required from central banks to bring down inflation to the rates that you're expecting. Right now, we're gaming at a 5.4% terminal rate for the Federal Reserve and seeing it staying there for much of this year. Ira, do you think that that's enough, or would you go further?
Well, so one of the things that we've noted for a long time is that the Federal Reserve, at least in the last 3 or 4 cycles, has always hiked until the real Fed funds rate has been positive. So that means that the Fed funds rate's above the year-on-year PCE deflator level. So we're going to get there probably when we get above 5% or 5.25%. So 5.5% doesn't seem unrealistic to me. Will we have to go higher than that? That really depends on whether or not inflation reaccelerates. And there is a big risk to our view, and that risk is that things like goods prices, which we saw in January, according to both the PCE deflator and the CPI data, actually started to stabilize, and we thought would continue to fall modestly. And because it's been running a little bit hotter, there is a big risk that if inflation reaccelerates, the Fed will have to go more. Now, that's not our base case scenario, but clearly that's something that we have to watch the data very closely for. And one of the reasons why we'll be watching some of the data, like the ISM prices, as well as what happens to wage growth, particularly in the services sector, when we get payrolls next week, because services has really been the impetus for a lot of the inflation that we've been seeing over the last 6 months or so.
We're moving forward to the U.S. data that we're expecting in about an hour time, and then what we're seeing next week. But this comes after that inflation read in Germany with a shocking 9.3% February CPI read, which is unthinkable for a nation that had hoped to have defeated inflation and tried to avoid taking out debt to avoid the spirals that it saw back in the 1940s. How much are we looking at a global bond market that is very much influenced by inflation from nation to nation, pushing rates up globally?
Oh, it's all about inflation, quite frankly, and you have some interesting dynamics going on where the global interest rate environment has completely shifted from where it was 2 years ago, and in Europe in particular, I think that they started a little bit later than the Fed did, and it's possible that the Fed is going to have to hike. The ECB is going to have to hike, at least a few more times, if not many more times, and they've been reluctant to do that. I think in part because some of the inflation there obviously has been influenced by exogenous factors like the war in the Ukraine, but at the same time, their mandate is to get inflation low. So in order to do that, they might have to hike even more than what the market's currently pricing.
Ira, a question from another time and place. I don't think I've asked this question well in excess of 15 years. With the inversion that we have, is some of it foreign buying of our longer maturity debt, keeping the price up and the yield lower? That's a question from a Greenspan era. Is that happening now?
Very, very modest. It actually, when you look at who traditionally have been the bigger buyers of our debt, it's been central banks. So one of the reasons why foreigners have owned so much of the U.S. debt, it's been the fact that we've had massive current account deficits. But Tom, I think you're right. And if you look at foreign flows into U.S. Treasuries, and you look at private foreign flows in particular, so these are flows from pension funds and other types of real money investors, those continue to come in at a reasonably high pace, even though central banks are cutting their holdings of treasuries. So and private investors are buying 10-year, 30-year debt, and you can see that in some of the auction data that we've been receiving. Some of those auctions have been pretty strong at a couple of the recent months. We can't say this month, but in recent months, and because of that, part of that certainly is because of long end buying by foreign private investors, for sure.
Ira Jersey, thank you so much for the brief. Look for his publications, Bloomberg Intelligence, just a great team there, particularly in the short maturity area. Ira doesn't like to go out past 2 years. It's just, bad form and all that. I was shocked here, Lisa. You were doing a question here, and I was going back and forth between BBC football and Formula One and that. And then I wandered over to the U.S. 30-year mortgage rate, topping through 7%. I did not realize we did that in the last 2 days.
I think we got back
7.03% on what I follow the 30-year bank rate mortgage. That's
went back
stunning.
Up to the levels that we saw last in November, because
7.35.
It's basically this feeling that we're going back to an era before disinflation, which was 5 minutes ago. There is this question of how does this really trickle into the real economy? And there was a story in the Wall Street Journal that I read about how a growing number of home purchases in the U.S. are all cash, which is not surprising, because if you're going to buy a home and you have the cash, then you can avoid a 7% kind of what would have been thought as punitive in a 3% era kind of mortgage rate. But what this does is it just basically means if you have cash, you're in so much of a better position than if you don't to buy a new home.
Back to biblical times, even in times of hardship, the haves can take advantage of price down, and if they've got all cash, which they do, they can do it. The moving average study on the 30-year mortgage is 7.14%. So we are 11 basis points away from the series touching the moving average study.
How many people are actually paying that? That's my question. How many people are actually paying a 7% mortgage rate, given the decline that we've seen in mortgage applications?
It's all microdata.
Mortgage applications came in this morning. They were lower by 5.7% month over month, just to show you.
It has been an extraordinary morning. There's no question about it. We're going to continue this discussion on radio, on television. Stay with us. This is Bloomberg Surveillance.